This is an environment that is very volatile.
In general, things have been drifting more positive.
Yields still look elevated versus where they've been.
Our long-term outlook for the equity market is that the returns are going to be lower than they have been over the prior 5 or 10 years.
Everything is expensive right now. And I think we should expect lower returns across the board, both from stocks and from bonds.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, hello September. The S&P 500 heading into a big month on a 4-month winning streak. As President Donald Trump's tariff plans are facing another legal setback, long bond yields from the UK to France and Japan are breaking out to fresh multi-decade highs.
There is so much to unpack this week. Wall Street is back, supposedly. Washington is back. Economic data is back. And this was the point in the year we were supposed to have more certainty. Bond yields were supposed to be more calm because we had a sense of what the tariffs were going to do, what the geopolitical backdrop was going to look like, and what deficits would look like. And right now it looks like we're anything but. The fog is getting thicker as there are questions around what will happen with the tariffs, as well as, frankly, what's going to happen with some of these governments around the world.
Let's start with this bond market. Stateside, getting closer to 5% on 30s. In the UK, 30-year bond yields the highest since 1998 in France, 2011 in Japan on record. You're seeing this all around the world.
And you could say maybe this is just because of the United States, but actually, no. You have, of course, the no confidence vote next Monday in France. They could potentially upend not only this government, but also its plans for stripping back some of the spending that are hugely unpopular. With the United Kingdom, it's going to be maybe the Starmer moment. That's what people are speculating. It's not going to be the Rachel Reeve moment, although she has to face off with a slew of terrible options. This is the doom loop that you keep talking about when you have bond yields going up, borrowing costs going up, and you have revenues coming down, and you have an economy that isn't growing. How do you put that together with something that actually is feasible for the currency and for the bond market?
Well, to your point, that last point, really important. The currency and the bond market, the tension in the UK. Bond yields up, sterling weaker. The pound, the biggest one-day loss so far going back to April. Sterling down by more than 1%.
And this comes with a backdrop of supposed dollar weakness. People saying that the Fed, because it's going to be so politicized, is going to cut rates, is going to allow inflation to go up, and that's going to cause the dollar to weaken. And yet, against what? And this is really showing this in prime light. The idea of the United Kingdom not providing an alternative, the European Union with France and the yields on those bonds versus Italian bonds shrinking to the narrowest since 2003, not coming from there. So where is the leadership coming from? And the fiscal responsibility that is really what a lot of the bond markets really are looking for.
We've got a big month coming up stateside as we anticipate the payrolls report. The estimates are in, starting to build. The median here at Bloomberg, 75K the range, the high's 115, the lowest 0. That's how Friday is set up so far, going into payrolls.
What's the biggest risk event? A better than expected payrolls report or a weaker than expected payrolls report? And I say this at a time when the entire market got a sigh of relief after the Jackson Hole speech. Oh, the Fed's going to cut rates. How high is the bar for the Fed not to cut rates later this month if we get, say, a really good payrolls report, or is it in the bag? And then suddenly people have to wonder, are we going to see some sort of reacceleration of inflation? I know I sound like a worrywart to start the year, start the school year, but truly, this is going to be a momentous time where not only there's a question about what the data is, but what we do with the data, both from an economic perspective as well as a political one.
I'm right there with you. The inflation story front and center. We get an inflation print next week on the 11th. Gold at all-time highs. More still to come on precious metals. In the equity market, equity futures negative by 0.5% on the S&P 500. In the bond market, that's where the headlines are this morning. Coming up this hour, Pelosky of TPW Advisory with stocks on a 4-month winning streak. We'll catch up with the former NEC Deputy Director, Everett Eissenstat, with President Trump's tariffs in legal limbo. And Leland of China Beige as she warms ties with India and Russia. We begin this hour with stocks looking to add to 4 months of gains. Pelosky, the founder of TPW Advisory, writing the following. The global bull market is broadening out as more and more markets hit all-time highs. As we enter fall, we would not be surprised by a performance chase into year-end. Jay joins us now for more. Jay, welcome to the programme, sir. A different character in the equity market rally of the last month. Small caps up 7%. Double-digit gains for the home builders, for the airlines for the month of August. Jay, do you believe that can continue?
Yes, certainly in the case of small caps, John. It's great to be with you and Lisa, even at this early hour. I'm impressed by you guys, how you do this every day. Yeah, we're constructive going into year end, and we're looking at the laggards. So, small caps is a laggard, energy is a laggard, things of that nature are starting to perform. And we think that's what's going to continue to confound investors who have been, playing off the back foot since April. And so we expect a performance chase into year end. For us, we're basically rotating out of U.S. tech into laggards within the U.S. as well as emerging market equities. And then, as I say, very bullish on commodities, very bullish on energy and on renewable energy in particular.
Jay, just want to pick up on what's happened with the Federal Reserve and how it might inform some of those views. Lisa mentioned it. This is a Fed now, led by Chairman Powell, that seems to be more worried about jobs and less worried about inflation, and perhaps even more tolerant of it. Now, that second point, I think the framing of it, Jay, is really, really important. Do you sense this Fed is more tolerant of higher inflation? And how does that play into this view of what's been happening with small caps and, for that matter, with bond yields worldwide as well?
Well, we think that the focus really is fiscal, John, and we've been talking about this for over a year. Monetary policy less important, fiscal policy more important. That's why you see the long end breaking out, as you pointed out at the open here, around the world. It's a global issue, and that's because governments have to spend. Governments have to spend on AI, on climate, on defense. There's no choice. These are all existential. And so we expect that to continue. We've talked about this before on this show. We've been out of government bonds for years, haven't owned a treasury bond in several years, and continue to feel that way about the rest of the world. So to us, it's all about fiscal. It's all about growth. Fed is less important. If the Fed doesn't cut, that's probably sets up a little bit of a pullback here. That would be viable because I do think people are now believing that almost with a certainty the Fed will cut later on this month. If they don't pull back, it's viable. If they do, markets continue to be okay. Look, and the issue is not economics. It's not politics. It's really quite simple. Earnings. Earnings drive equities, and earnings have been good. Forward earnings revisions globally are rising. You have liquidity, abundant liquidity around the world. People's Bank of China, ECB, Fed, all providing liquidity. And you have a very robust technical position underpinning the market. Just one quick example, 100% of the equity markets in the Asia Pacific are above their 200-day moving average. 100%. That's the first time in 4 years. We have a global equity bull market.
I'm just struggling to square the idea that we could see yields, particularly on the long end, continuing to rise because of fiscal spending, and you could see outperformance by some of the most yield-sensitive areas of the market. How do you square that circle?
Well, I think that there's leverage to rate cuts. So on the front end, right? The ECB has cut. We're in a global rate cutting cycle as well, Lisa, as you know. Vast numbers of central banks around the world have been cutting, will be cutting going forward. If the Fed joins them, small caps are the play. They have the most sensitivity. Small caps benefit from deregulation. That's a big focus of the Trump administration. So, I think there's a rationale here. And look, what we think is kind of interesting is that there are record short positions in things like small caps. There's the most bearish oil positioning in 25 years, according to folks who really focus on that segment. So there's a lot of negativity hiding out in pockets of the market that have not performed. And as they start to perform, we think that is the catalyst and the kindling for the run up into year end. Because if all of a sudden the places where people are hiding and are negative flip to being positive, as John pointed out, small caps up 7% in a month, then you've got to get on that train. Particularly if December is only a few months away.
I've actually been somewhat surprised that markets have completely shrugged off the court ruling that happened late last week, when we really have to rethink whether these tariffs that Trump has put on will be able to be maintained. And I know that there are other options, but it raises a question for the bond market, and it raises a question for fiscal spending. How much does this actually not plug a hole in the deficit that's crucial? It's going to send yields even higher. And then how much does this force more cuts, not more spending? in order to offset that. Jay, are you just dismissing the possibility of cuts that have been proposed in places from the UK to France to here in the United States?
Cuts in rates? I'm sorry.
No, cuts in fiscal spending.
Spending. Okay, thank you. We wrote a piece 6 months ago now called the Stoic Strategy, right? Where we said the number one strategy to invest in the age of Trump is to ignore everything that Trump and his administration have said. That's worked out phenomenally well, right? It's been an investing superpower to ignore Trump and his admin and focus on the things we just talked about. As far as spending cuts, look, it looks like places like the UK are facing those issues. We don't think that's an issue in Europe. We expect growth next year. Not only are we looking into year end, but we're now looking into 2026. In 2026, two big things we expect to see happen. One, better European growth driven by German stimulus, defense spending, etc. Two, most importantly, China defeating deflation. We are super focused on China's ability to defeat deflation and drive economic growth. We expect that to happen. We're watching the 10-year government bond in China as our bellwether signal there. I think it's the single most important macro number in the world today. As that heads north towards 2%, suggesting that deflation will be defeated in China, those are the things that are going to drive markets, not frankly whether spending is cut in the UK, for
Jay,
example.
just final question. I just want to jump in. That point on China is an important one. If you believe they can defeat deflation, do you also believe they're going to aggressively cut excess capacity? If so, and where? And has that changed your views from sector to sector?
100%, John. You're right on top of it. No surprise, buddy. And where the opportunity is in renewable energy. Right? China has a two-pronged approach to defeating deflation. The first, anti-involution, reduce excess capacity. That's focusing mostly in the renewable energy space, in solar and in wind and in EVs. So what is breaking out, interestingly enough? Renewable energy. ICLN is the ETF that we focus on. It looks like a champ. It just broke above its 200-day moving average for the first time in over a year. The second prong is consumption, right? Fiscal stimulus to drive consumption, to drive demand. Moving on to cash handouts. China is actually engaging in cash handouts to stimulate consumption. And so the big opportunity, as we see it right now, to benefit from this beyond, China large caps and K-Web, which again, you and I know, we've been invested in overweight China for close to 2 years now. But the big opportunity right now is in the renewable energy space as a play on China successfully defeating deflation.
Hey, Jay, great to catch up with you, sir. Jay Pelosky of TPW Advisory. Let's play this out one further step and take another asset class. Let's say Jay's right on China. What does that mean for the global bond market if China actually slays the deflation beast? What does that mean for this bond move we're seeing already take place around the world?
So you're looking for some sort of discipline and you're not going to find it suddenly in China. Well, then all bets are off and you've got this global inflationary cycle with maybe China demanding higher prices for their goods because they're going to cut some of the overcapacity. In other words, if you're looking for anyone to tame inflation, it's been China. If they're going to reverse that, well, let's see how high these yields can get.
Gold gets it. Record highs for precious metals. Let's get you an update on stories worldwide with your Bloomberg brief and some breaking news. Here's Yahara Arnold. Hey, Yahara.
Hi, John. Exactly. The Kraft Heinz Company's board approved a plan to separate the firm into two independent publicly traded companies through a tax-free spinoff. The two resulting companies will have names determined at a later date. Kraft Heinz expects the transaction to close in the second half of the next year. The companies had merged about a decade ago. Meanwhile, the Trump administration is preparing to take its case to the Supreme Court after an appeals court ruled that the bulk of Trump's global tariffs were illegal. Treasury Secretary Scott Bessent saying the appeal will emphasize the long-standing trade imbalances facing the U.S., as well as the need to curb the flow of fentanyl into the country. And China, Russia, and India are deepening their diplomatic ties, which was on full display at a summit in China. Leaders of the three nations have been pushed closer together due to President Trump's tariffs. And the partnership between Beijing and Moscow is growing as President Vladimir Putin appears to have secured a deal to build a gas pipeline to China through Mongolia. That's your Bloomberg Brief. John?
Yahaira, thank you. More Yahaira in about 30 minutes' time. Up next on the program, President Donald Trump's tariffs face a legal setback.
We think we're going to win at the Supreme Court. We are close to a tipping point where we could have financial instability due to these large and persistent trade deficits. So we are trying to head off a crisis.
Up next on the program, we'll catch up with the former NEC Deputy Director Everett Eissenstat, live from New York City this morning. Good morning. From New York City. Welcome to the program. Here's your week ahead. Later on this morning, some economic data, ISM manufacturing data. Look out for that through the week. Lots on the jobs front. Concludes on Friday. Payrolls Friday, just around the corner. In the equity market, equity futures pulling back by, let's call it 0.5% on the S&P 500. Following some massive outperformance on smalls, the Russell 2000 is negative by 0.8. Let's just sit on the bond market for a few beats. I want to talk about 10s and 30s. In April, when this administration came out with some major tariffs, it was bond negative. In August into September, as the courts challenged these very same tariffs, it's bond negative. Go figure.
People thought that this would be problematic in terms of both the deficit and with respect to U.S. trading relationships. They underestimated back in April how much revenue, actual tangible revenue, would be brought in and how much that would offset the deficit. Without that revenue, what does that do to the fiscal backdrop and to the bond market? And that is the reason why it was negative then and negative today.
Remember Mohammed Al-Erin would talk about all these little fires? All these little fires in the bond market right now in the US. The UK has its own issues, France, Japan, seeing it all build into one big monstrosity, potentially at the long end of the yield curve worldwide.
Yeah, bonfire of the credibility of developed market economies and actually cutting their deficits and being able to do so effectively at a time of raising costs. Bonfire of the vanities, sort of 2025.
30-year bond yields up by 5 basis points, closer and closer to 5% on a 30-year maturity stateside. Under surveillance this morning, President Donald Trump's tariffs face a legal setback.
We think we're going to win at the Supreme Court. We are close to a tipping point where we could have financial instability due to these large and persistent trade deficits. So we are trying to head off a crisis.
So here's the latest this morning. President Donald Trump facing a legal setback in his tariff agenda after a federal appeals court ruled most of the levies are illegal. The Trump administration vowing to take the case to the Supreme Court. Bloomberg's Tyler Kendall joins us now for the latest. Good morning, Tyler.
Hey, John, good morning. So these are the tariffs that have to do with IEEPA, the International Emergency Economic Powers Act. And the court ruled that President Trump overstepped his authority because in order to invoke IEEPA, the president had to declare a national emergency that the administration felt warranted a tariff response. So in the case of the so-called reciprocal tariffs, the president cited persistent global trade imbalances. And in the case of those tariffs against Canada, Mexico, and partly on China, the president cited concerns when it comes to fentanyl and the border. Keep in mind here, courts have actually been historically pretty deferential to presidents and their ability to declare national emergencies. But we've never seen a White House invoke IEEPA in order to impose tariffs, let alone such broad-ranging ones. Now, for the time being, these levies are allowed to stay in place while they make their way through the court system. But I want to make one really critical point here. The appeals court upheld a lower court ruling from the Court of International Trade, but it actually urged the lower court to re-examine its ruling and how it applies to everyone instead of just the parties that sued, essentially looking into whether or not this decision really should be universal. That could have some pretty big impacts here and leaves this White House with really two options on the table. One, they could have the lower court retake up this question and relook at the issue, or they could appeal directly to the Supreme Court. And at this point, John, it seems like they're headed in that direction. You just heard the Treasury Secretary. They are saying that they are prepared to take this all the way. And we are expecting Besson to actually put forth a brief to the Solicitor General as soon as today. Of course, that's the one that would be arguing this in front of the High Court.
Tyler Kendall down in Washington, D.C. Tyler, thank you. To build on this conversation, joining us now, the former NEC Deputy Director, Everett Eissenstat. Everett, welcome to the program, sir. Companies don't know how to price this. Governments don't know if they should or shouldn't negotiate with this government now. What do you think the next move is?
Well, I think as was indicated, I think the administration is going to go to the Supreme Court and get a final determination on whether the tool they use to put these tariffs in place are going to stand or not. If they fall, they've got a lot of other options. They've got many different statutes they could go to. They could go to Congress and get some, revised statutory authority. So it is an important matter, and it is quite significant, but it is not the end of the story by any means. There's a lot of other options out there.
At the same time, the court decision stayed these tariffs and kept them in place until October 14th. And it seems like that's a pretty ambitious timeline for the Supreme Court to see this case. What happens for companies between October 14th and whenever the Supreme Court takes this up, given that they could be owed compensation for what they already paid for tariffs?
It's a really important point. I think one of the things we've been counseling clients is to be sure to be tracking their import data. What are they bringing in? Making sure they file protests at the appropriate time, understanding their liquidation dates, because there may come a point in time where a company has to take a proactive stance to actually go and get these tariffs back. Traditionally, if a tariff like this, fell, the government might say, okay, well, it applies to everybody. Everybody can get their revenue back. We don't think that's going to be the case. We think this administration is going to work hard to retain that tariff revenue, which will put the burden on companies to actually go out and get the revenue back that they've already paid. So being diligent and keeping track of those expenditures is going to be very important.
This was supposed to be the time of the year when companies had more certainty and would actually engage with plans of acquisitions, mergers, investment. How much do you see that stymied because of the lack of clarity here?
Yeah, there's no question about it. I mean, we see it all the time. Every time we think we're going to get some foundational understanding of the trade environment, something happens. Court ruling comes, a new tariff measure comes out. I mean, India and Brazil are two examples, but we have some other tariffs that are coming down the road as well. There's a number of 232 national security investigations ongoing on really important sectors of the U.S. economy, like critical minerals, pharmaceuticals, semiconductors. All of these have implications for companies' supply chain investment. So I think for understanding where to put your money as a company, where to invest, and the best timing, I think it's quite a challenge. And they still don't have the certainty that they'd like to see to make those big long-term investments.
Everett, you mentioned the 232 investigations. Do you think that perhaps some of those investigations will be delayed until we have a conclusion on the legal issues around IEEPA? Because if they need to use different tools, maybe they need to wait and see if they do need to do that or not.
Absolutely not. I don't see any delay. And if anything, I see an acceleration of those. One of the things that even the president had kind of indicated over the weekend, or leading into the weekend after this court case had been dropped on Friday, was that they are going to use this national security law, this 232 law, to expand the scope of tariffs. Now, what we've seen with the steel and aluminum tariffs that are now at 50%, just recently there were 400 petitions from companies that sought to have their products pulled into these tariffs. And almost all of those were granted. So companies were sitting back. They hadn't been affected by the tariffs. This new inclusion process is a way to bring a lot of product into the tariff regime. And it's being used very aggressively. So I would actually expect an acceleration of the 232s and an expansion of their scope, because if the IEEPA tariffs fall, they're going to want to have this tariff revenue. They're going to want to have this backstop.
Everett, appreciate your time. As always, thank you, sir. The former NEC Deputy Director, Everett Eissenstat. What did you make of Secretary Besson's argument? We're close to a tipping point where we could have financial instability due to large and persistent trade deficits.
He's trying to figure out, how do you make this an emergency? You don't call fentanyl an emergency, and you can see that legal argument getting shaped.
Stocks down. Bond yields higher. That's the price action so far this morning. Coming up, China Beige Book CEO Leland Miller as President Xi signals unity with India and Russia. Four months of gains on the S&P 500, the longest monthly winning streak of the year so far. Equities kicking off September, lower by 0.7% on the S&P, lower on the Nasdaq by 0.9%, and likewise on the Russell 2000. Small caps in August up 7% this morning, down by almost 1%. In the bond market, 2-year, 10-year, 30-year bond yields, big move lower at the front end of the curve through last month, thanks to a weak payrolls report and a dovish Fed chair, Jay Powell. 2-year yields, 365, 36 this morning, higher by 3 basis points, but the longer end of the curve will get your attention, not just stateside, but worldwide. 30-year bond yields getting closer to 5% in the United States. In Japan, at record highs. In the UK, the highest since 1998. Now, this is the toxic mix we've talked about so often. Yields up, currency weaker. You see that tension, that pain building in the UK.
And you've talked about this, the emerging markets like dynamic, where a company is hamstrung by its debts at a time when they cannot grow their economy. So how do you get out of it? Do you make cuts that just add to some sort of pain in the economy, that shrink the economy further? Does that actually gain the confidence of bond investors? And I will ask this. Right now is a great test. Is this enough from the bond vigilantes to force discipline on a government? Are we seeing the tipping points, or do we have to see more pain around the world before governments make the hard decisions to make certain cuts and to make certain select investments? Prudent government.
Sterling, 133.87. We'll come back to that story in just a moment as we count you down to the opening bell. About 3 hours away. Let's get you some morning movers, some single names. Here's Danny Berger. Hey, Danny.
Hey, John. NVIDIA, because of its weight, was responsible for 40% of the S&P's decline on Friday. Its reign of terror continues today. It is down 1.5%. This would be the 4th consecutive day of declines, the longest losing streak since March. The catalyst, take your pick. Is it higher bond yields? Is it because of its earnings? Is it because Alibaba is developing a new chip in China? It's unclear, but otherwise, NVIDIA is sinking lower. Moving to the upside this morning, however, is Frontier Airlines. This is on some sell-side action after Spirit Airlines on Friday declared bankruptcy for a second time. Analysts at Deutsche Bank pointing out that Frontier is most likely to be the biggest beneficiary of that, another budget airline. It overlaps with a lot of Spirit's routes, so you'll see consumers perhaps moving to Frontier, those shares up 9%. Finally, ending things with Eli Lilly this morning. Yesterday, we learned that Novo Nordisk did a real-world study of its drug Wegovy and found that people with cardiovascular disease, the risk of death, of stroke, of heart attack fell 57% versus that of Lilly's offering. Analysts noting that this could be used for advertising against Zepbound, so those shares down 1.6%, John.
Danny, thank you. Appreciate the update. More from Danny in the next hour. On our radar this morning, one of our top stories, the Treasury Secretary Scott Bessent expressing confidence the Supreme Court will uphold President Trump's tariffs. Reuters reporting that Bessent is also eyeing another legal methods to impose the tariffs as a backup plan. Our second story, President Trump considering declaring a national housing emergency this fall as the administration gears up for the midterm elections. Scott Bessent saying housing affordability would be a critical leg of their platform. And finally, the biggest story in the bond market this morning, long-dated UK bond yields climbing to multi-decade highs as investor confidence wanes in Prime Minister Keir Starmer's government. Yields on 30-year gilts climbing to nearly 5.7% as concerns continue to mount over the country's budget trajectory.
If you want any positive spin on this, you could say the trajectory hasn't been the spike upwards that we saw a number of years ago during the Liz Truss moment, that it hasn't been as rapid of a momentum. But I would argue that actually the slow grind higher in yields, the slow grind weaker in the pound is actually more concerning, because what it signals is not necessarily some forced sale, but a gradual and persistent loss of confidence in the UK's ability to really get their budget around at a time when they are facing this question about their deficit expanding and growth that's weakening. And that really is the toxic brew that everyone wants to avoid.
I think in addition to that, Lisa, I'm so pleased you said it, they've lost control of the messaging. If you follow the domestic press in the UK over the past few weeks, I've seen suggestion after suggestion of new tax hikes in the United Kingdom. Many of those won't even make the light of day. But the problem with that is every single day you have a story like that out there, you lose more and more confidence. And the problem the UK's got at the moment is they keep putting up taxes and the tax base keeps disappearing. A lot of people are just leaving the country. And if you keep floating more and more tax hikes, guess what people are doing? They're not investing, and they're not going to remain in the United Kingdom if they've got money or any ideas to invest in a business anytime soon.
So how do you do it? And this is really the quandary that the Starmer administration faces. Do they cut a lot of the services around the board? Well, they tried that. That didn't go so well. How do they raise revenue? How do they bring investment back at a time where they don't have the luxury of pro-growth measures? And this is really interesting for the United Kingdom, but also at a time where this is an issue everywhere. This is happening in France as well in a massive way when they're proposing cuts that are so deeply unpopular. Remember, they were going to take away a national holiday, and that turned into a national catastrophe. Was reversed. So how are they going to shore up their economy before they reach that point? And that, I think, is the big concern.
You've got the tax lever and the spending lever. And if you're on the left, you keep reaching for the tax lever, and that's the problem. Secretary Besson has said this quite a few times. We don't have a tax problem, we have a spending problem. And they have a spending problem in the UK and a spending problem in France, and no, seemingly, ability to do anything about it or willingness for that matter, both in the UK and France. Now, France has got an excuse. France can turn around and say, we simply don't have the numbers in Parliament to get this through. We need help from elsewhere. The Labour Party does not. They have a massive majority in Parliament and can't make it happen.
Yeah. This is the difficulty right now, because ultimately, where do you make cuts? And what do you do to the economy in the short run, and how do you avoid the blame? The tax lever isn't going to work. We already know that because we've seen the tax base get dissipated around the world. But the spending lever is a real question mark when you have a decelerating economy. How much pain are you willing to tolerate? And then what does the Bank of England do with that? And this is going to be a case model, maybe, for other nations around the world.
The highest since 1998. It's not pretty in the UK. And to Lisa's point, it's not pretty elsewhere either. Let's turn to geopolitics. Chinese President Xi Jinping, the Russian leader Vladimir Putin, and Indian PM Narendra Modi presenting a united front at China's annual Securities Summit. Joining us now is Bloomberg's Min Min Lo. Min Min, welcome to the programme. Just walk us through what's been happening over the past day or so.
Yeah, today Putin and Xi had a meeting, and it was one that came with a lot of breakthroughs, because the big deal that was signed was between the Gazprom, which is Russia's state-owned company, and China agreeing to build this Power of Siberia 2 pipeline, which would help to divert a lot of the gas pipeline sales to Europe to China instead. And that would help the company recoup about 30% of those gas pipeline that was diverted, that used to be sold to Europe to China. So, and a very important breakthrough, because this was something that has been under discussion for many, many years. President Xi and China have been reluctant to sign onto the deal because they didn't see it as urgent to continue to step up gas purchases from Russia. They didn't want to over-rely on Russia as well. And this deal coming as President Trump has been threatening more tariffs on China if it continues to buy Russian oil. Interestingly, we see the same thing with Modi as well. Modi's India's largest state-owned company, oil company, saying it will continue to buy every single drop of Russian oil available as long as it remains economical. Really a slap in the face for President Trump, and perhaps showing that Trump's additional tariffs to punish India is in some ways backfiring.
Min Min with the Lotus. Min Min, thank you. Appreciate it. Min Min Lo there of Bloomberg. The kind of imagery that would irk this White House big time. These three leaders in one room.
It is the imagery, though, that might speak louder than any kind of real relationship. And that is the ultimate question. How close can these ties get? I will say the idea of Putin and Xi being the ultimate statesman is really quite ironic.
It's quite something, right?
Yes, absolutely.
Yeah. OK, let's extend some of this with Leland Miller, the CEO of China Beige. Leland joins us now for more. Leland, welcome to the programme. Is China and President Xi, from an economic standpoint, operating from a position of strength?
I wouldn't call it a position of strength, but it's getting stronger considering that a lot of countries are backing away from their close relationships with the United States. I mean, if you look what's happening with India right now, India doesn't want to be looking around the room and see China on the left and Pakistan on the right and Belarus across the room. I mean, it would rather be in a group of countries, the United States and others, and strengthening trade relations there. But it will push back if it thinks it's being pushed into a corner. And so we're seeing a situation where China is becoming an attractive option because it's not the United States right now.
It seems like Russia and China have a very clear relationship. China is almost the owner, or Russia is the vassal state of China because it is so dependent on its revenues. The relationship between India and China is much more complicated. How do you see that evolving? How close can that get, given how incredibly contentious the relationship has been for decades?
Yeah, look, India considers itself a non-aligned country, and a lot of countries do in Southeast Asia too. That have said they're not going to be a U.S. ally directly or a Chinese ally. They're going to manage relations with both. I mean, you've got Indonesia, you've got Vietnam, you've got a lot of other countries. But within that non-alignment label, there have been tightening relationships for years and years in the United States. It's been geopolitical, it's been economic, it's been trade. These things have been very advantageous to U.S. policy goals, trade and foreign policy and even military in the Pacific region. And if all of our policy ends up backtracking to become one big question about sort of fair trade, but it doesn't have any look at the geopolitical side instead, and how are these things balancing out, then we're going to wake up 5 years from now. We're going to realize that we've just undid 20 years of diplomacy that have sort of pushed back against a China-led world. It's a problem.
How much are you already seeing some of these new alliances in the trade data? I mean, we've seen, for example, Chinese exports that have decreased substantially to the United States, but that have increased substantially to the rest of the world. Do you see that along alliances, or is this just transshipments? The idea of finding the weakest node that they can get products in that can eventually get to the United States?
Yeah, it's not alliances, but it's not all transshipment either. It's essentially China shoving its exports down other countries' throats. And, the United States has, you can see it in our China Beige Book data. You can see it in other trade data. The direct shipments from China to the United States have been going down, but China has been just unloading its exports, in particular into Southeast Asia, because they can't push back. They can't push back geopolitically. They can't compete with Chinese lower prices that are sort of dumping their overcapacity into Southeast Asia. So it's not about tightening economic block. If anything, it's the opposite. But it means that in a world in which China is trying to find places to dump its exports, it's picking on its weaker neighbors, and it's being very successful right now.
Leland, can we just stand that point? China's overcapacity. We had a guest on the program about 40 minutes ago making the argument that China was going to address that. Do you see any sign of that whatsoever?
It's one of these things that people read they read what the government's plans are, and they say, oh well, the government must be willing to address this. They're going to have more consumption. They're going to have more stimulus. They're going to have they're going to combat overcapacity. Finally, the model doesn't allow for them to do this very easily. So look, if it was a priority in the short term, yes, I think that they're doing little things. This anti-involution campaign, they're trying to weed out some of this price competition that comes from every provincial government in China subsidizing the same stuff, leading to oversupply, leading to exported oversupply and this overcapacity problem. So yes, in the short term they're going to deal with it on a micro level, but the economic model that China has, which is stimulus to the supply side and not to the demand side, it does not allow for them to shift things away. They're going to have more overcapacity, and they're just going to have to find places to bury it until someone or some bloc forces them to do otherwise.
Leland, just why are they married to that particular model? What would it take to make them change their mind?
Well, I think it's what Xi Jinping and Chinese communist leaders have fought for a long time. What they want to do is they want to produce more. They want to build up their industrial base, and that's fine, and that's laudable from their perspective. But what has happened is it's all the stimulus. The entire model is based on spurring more production and more exports, and they've been very explicit about that in the last couple of years in particular. So as long as you're trying to produce more, but you have very weak domestic demand, and you're doing absolutely nothing structurally in order to empower consumers or households or the private sector to become more consumers back home, what you're doing is you're having a model that's completely reliant on production. And that's what the model is right now. It's why China is very vulnerable, but also not a very good trade partner for others who want them to import more.
And why the US has been so frustrated over the last decade or so. Leland, appreciate your time. Leland Miller there, the China Beige Book CEO. Some pushback to what we heard from Jay Pelosky earlier this morning.
Saying that it would be very hard for them to push back on this model of overcapacity, and that essentially they're making noise as though they can, but ultimately they would have to upend their entire economy in a way that there doesn't seem to be the impetus to do so.
It's amazing what's happened so far this year. Tariffs have gone up big time. Trade has broken down between the US and China, and yet still that budget surplus, that trade surplus rather, in Japan is bigger and not smaller with the rest of the world.
Well, that really is the issue, right? Is this going to cause some sort of unrest in Southeast Asia? How do they fight back? And then what is the U.S.'s role? Is the U.S. truly stepping away from being any kind of safeguard or any kind of alliance or allied partner? And that, I think, is what a lot of people are grappling with.
If you are just tuning in, welcome to the programme. Bond yields higher across the curve this morning. Equities lower. Stocks are down by 0.75% on the S&P 500. That's the price action. Let's get you an update on stories worldwide this morning with your Bloomberg Brief. Back with us, here's Yahara. Hey, Yahara.
Hi, John. A plane carrying European Commission President Ursula von der Leyen was affected by GPS jamming as it landed in Bulgaria. According to authorities, the GPS signal was neutralized as the chartered plane approached Plovdiv Airport, forcing air traffic control to use alternative navigation tools. Bulgarian authorities blamed Russia for the incident. Meanwhile, gold prices climb to record highs as investors add exposure to the precious metal in anticipation of rate cuts from the Fed. Gold has risen more than 30% so far this year, as you can see there, making it one of the best performing major commodities. Traders are looking ahead to Friday's jobs print for further signs of rate cuts, which add to gold's value as it doesn't pay interest. And Nestle has abruptly dismissed its CEO, Laurent Frex. An investigation found he had an undisclosed romantic relationship with a direct subordinate, of course, violating the company's code of conduct. Frex will not receive an exit package, and he'll be replaced by Philippe Navratil, who had overseen the company's Nespresso coffee brand. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time in the next hour. Up next on the program, global bond yields grinding higher.
The narrative that somehow something had dramatically changed about the behavior of the dollar, it's really too early. People point to the correlation between what's happening with long-term bond yields and the strength of the dollar and saying, well, that's changed, and therefore something has changed dramatically.
A conversation up next with Sonja Marten of DZ Bank, live from New York City. You're watching Bloomberg TV. It's a tough start to September. Equities down, bonds down, yields up. We're down by 0.7% on the S&P 500. Underperformance on the Russell, where there has been some outperformance more recently. We're down by 1% so far this morning on the Russell 2000. If you switch up the board and get to the bond market, check out the long end of the curve. Yields higher on 30s by 5 basis points, on 10s by 6. 30-year bond yields getting closer and closer to 5%. 4.98 so far this morning. Under surveillance this morning, it's global bond yields grinding higher.
The narrative that somehow something had dramatically changed about the behavior of the dollar, it's really too early. People point to the correlation between what's happening with long-term bond yields and the strength of the dollar and saying, well, that's changed, and therefore something has changed dramatically. That's not the case. If you take a long enough period, the relationship between the dollar and the borrowing costs, it can move in different ways. So there's nothing unprecedented. But of course, these are still early days.
So here's the latest this morning. 30-year bond yields around the world climbing to fresh multi-decade highs in France, the UK and Japan. Joining us now to discuss is Sonja Marten, the head of FX and monetary policy at DZ Bank. Sonja, welcome to the programme. This move we're seeing at the long end of the curve, I just want your initial reaction to that, both in what's happening in the UK and France and Europe, but also here in America.
Well, I think in the UK, it's pretty obvious. We have some major fiscal concerns. I mean, Keir Starmer has just publicly humiliated his chancellor, and there's really a question of how long Rachel Reeves can hold on to her job. So that's triggered a new wave of fears. And I think we're still, in a way, witnessing the after effects of the trust budget a couple of years ago when people got totally spooked about, the prospects for the UK bond market. And I think in a way that's still hurting. So you can see yields moving higher sharply. You just mentioned the 30-year in particular. And we have seen fiscal concerns pretty much across the board. France, obviously, with the the vote coming up next week, there's a lot of uncertainty here, and it's just pulled everything up in its wake, I think.
Sonja, is the UK idiosyncratic, or is this doom loop really showing signs of beginning across the developed markets? You pointed to some of the other countries that are facing similar dynamics with increasing bond yields at the long end and just pressure on the collective currency. But do you see it being somewhat different than the dynamic playing out in England, in Britain?
Yes, I think we really have to be careful to differentiate here. I mean, there is a structural factor at play, which is obviously that we have seen, deficits rising, and that has triggered some concerns that are justified, and I will buy that. But we then have to differentiate what's happening. And in the UK in particular, I think what's happening here, the market is sort of starting to show, I wouldn't say panic, but there's clearly some nervousness in the market. But when you look at it, the DMO has already acknowledged the lack of demand for the ultra long end of the curve. There'll be less issuance there. The Bank of England can sort of shift around its gilt sales as well. And let's not forget one thing, even if yields at the long end rise very quickly right now, this does not impact the interest payments of the UK government on its existing debt. I mean, this doesn't translate right away into higher spending on interest rates. And that's just something I think people need to be aware of. So I think it's a little bit overdone at the moment. I don't expect this to turn into an absolute rout, no.
Hold on a second. Are you saying, Sonja, that the 30-year bond can't be the discipliner that a lot of people thought that it was, that this cannot be the bond vigilante slice of the market to come back with pitchforks and tell governments around the world, cut your deficits, that it won't act as that type of measure anymore? Is that your point?
Well, I would not go as far as to say that. I mean, it is a warning sign. I will say that it is a warning sign. And we have seen governments react to this sort of warning signal. Donald Trump himself clearly has reacted to that sort of warning sign before, and we've seen the same thing in the UK. It is a warning sign. I'm just saying we have to be careful not to conclude right away that if the bond yield rises, that automatically translates directly into much, much higher spending on interest payments. That effect will come in the long run, obviously, if interest rates remain high, but it's not, it doesn't happen one day to the next. So I think that's just something we need to be a little bit careful of, not to mix signals here.
Sonja, it can tighten financial conditions, though. And maybe it's too early to have this conversation, but I'm thinking ahead, a few steps down the road, maybe into 2026. Remember the ECB introduced the transmission protection instrument. And I just wonder if other central banks might look at the situation and say, look, we're cutting interest rates, but financial conditions aren't getting easier. Long bond yields are still climbing. Do you see central banks, either the Fed or others, thinking about stepping in here?
Well, I mean, when you mention the Fed, I mean, that's quite possibly a discussion that we're going to be having next year. I mean, the Fed, is going to be morphing increasingly into a sort of a very dovish institution with everything that's happening on the board. And so I do fully expect a discussion to come up in the US next year about the potential for the Fed to start, buying bonds again. I don't think there's any fundamental justification for this, and I think it would be very dangerous to do this unless there is a justification for these purchases. But I think a discussion about this is likely to happen in the US next year, definitely.
Sonja, appreciate your time. As always, Sonja Marten there of DZ Bank on the latest situation in the global bond market and with central banks too. This from Peter Cheer over the weekend from Academy. At least I'm sure you saw the same thing. People aren't thinking out of the box enough and may well be underestimating this administration on their plans for bond yields.
Yeah, ultimately, we could have yield curve control. We could have shifts in terms of where issuance is happening. We already are seeing that on the margins. But this really underscores why we're seeing such a bid into gold, right? Ultimately, you've got governments around the world that are facing off with higher costs at the long end as they try to cut yields at the short end. It turns out monetary policymakers don't have control over everything. So what do? You start to manipulate it, sort of the financial engineering that has really supported the economy for so long. What do you end up with? The depreciation of developed market currencies, the reason why people are looking at gold at record highs today.
Chairman Powell contributed to that as well, showing a greater tolerance for above target inflation. That's been problematic for a lot of people.
There's been a feeling that the pain that comes with any kind of recession is worse than just a little bit more inflation and a little bit more. And if you look at five-year break-even rates, they're creeping higher.
Gold, 34.85. Coming up in the next hour, here's the lineup for you. Phil Orlando of Federated, Henrietta Treyz of Veda Partners, plus Matt Maley of Miller Tabak and Matt Hornbach of Morgan Stanley. The second hour of Bloomberg Surveillance, up next.
You have a situation where the Fed is clearly worried about the growth side of their mandate.
The growth story just isn't that great.
The uptick to 2.9% on the core PCE deflator is a little concerning.
Fed independence definitely affects the inflation narrative as well.
If the Fed does cut rates by 25 basis points in September, it's still not going to necessarily mean a sequence of rate cuts.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equities lower to kick off the month of September. We're down on the S&P, on the Nasdaq, the Russell, the S&P 500 negative by 0.75%. The epicenter for the pain worldwide, it's in the bond market at the long end of the curve. Here's 2s, 10s and 30s. Yields high by 5 basis points, getting closer to 5%. 497.69 on 30s, the highest yield since 98 in the UK, since ever in Japan, and in France the highest since 2011. The week ahead to set the tone for financial markets worldwide, a lot of labour market data stateside, including ADP in just 24 hours' time, and payrolls coming up on Friday.
You know, this is a very complicated week, given the political consequences of Washington coming back, the tariffs and what happened there, and then, of course, what happens in markets, the bond market response to the jobs data. What is the bigger risk? That the jobs data comes in better than expected or worse than expected? How high is the bar for the Fed not to cut rates later this month? And how much is the hope and prayer of those rate cuts, regardless of the economic backdrop, what's supporting this market? And that, I think, is a real question heading into what typically is a pretty volatile month for stocks.
Mike Apen of Morgan Stanley is trying to answer that question, going into payrolls for you. September cut is not a certainty. Payrolls of 225 in August. Another clear acceleration in tariff-related inflation could keep them on hold.
This is a highly political question, especially because Stephen Myron might actually be on the board by the September meeting, by September 17th. That is the goal. And on Thursday, you do see that Myron confirmation hearing. Do they fast track that to get that into practice? There's just a real question here about a reaction function at a time where inflation is starting to creep higher in terms of expectations and in terms of what the bond market is pricing in globally. That is a real question. How much does that stymie potential returns, not only in the bond market, but also in equities?
I got excited about ADP. 48 hours away for ADP. But for the first time in a long time, maybe ever, we're talking about an ADP number on par with payrolls. More attention being paid to that data point.
Yeah, on par or maybe even at some point superior, because this will be the first payrolls report coming after the firing of the Bureau of Labor Statistics head, because of the revisions that are bigger than expected, but also have been traditionally something that we have seen during periods of disruption. So how does the government, how does Trump's administration react to whatever number we get at a time where it already has been highly politicized? And a lot of people are wondering not only about collection rates, but also just about how things are manipulated. I don't know that I buy that. I got to be honest. I don't think that things are being manipulated. I think that there are too many staff people in place. I just think the accuracy is more a question.
The fact there's a question, though, Bramo, that's a problem.
100%.
Going into a big week for labour market data. Big out coming up. We'll catch up with Phil Orlando of Federated Global Investment as we kick off a big month for markets. Henrietta Treyz of Veda Partners as President Trump's tariffs bump into legal issues. And Matt Hornbach of Morgan Stanley as gold hits another all-time high. We begin this hour with stocks on a 4-month winning streak coming into September. Phil Orlando, the chief equity market strategist at Federated Global Investment, writing the following. We expect the Fed to cut interest rates by a quarter point at both its September and December meetings this year, which should boost stocks towards our 7,500 target next year for the S&P 500. Phil joins us now for more. Phil, good morning.
John, thank you very much for having me back.
Thank you for being here, sir. Let's talk about the month ahead. Payrolls this week, inflation next week, and then the big Federal Reserve meeting. How are things shaping up for you and the team?
So we've had this massive 35% rally off the Liberation Day bottom going into, I guess, the week before Jackson Hole. And then the market traded off about 4% or so because the market didn't really understand or appreciate what sort of a tone would Powell take at the meeting. Now, the rally we've seen over the course of the last week or so has been that Powell took the right tone, that the Fed is thinking about easing. But as we get back to, the day after Labor Day, everyone's back from vacation. Now, the cold dose of reality sets in. All right, what's the next set of inflation data going to look like? What is the labor market data this week? And then you've got all the noise surrounding the Fed and tariffs. And does Miran, does he get seated this week? So at this point, that dose of reality, we think, given the fact that we've turned the calendar to September, there could be some chop here looking out going into the September 17th meeting.
Well, let's touch on a potential source of tension. Let's say the move we saw in the last month to see cyclicals outperform, to see the airlines up double digits, the home builders up double digits, to see the Russell, the small caps up by 7% at a time where the chairman is increasingly worried about a cyclical downturn. Does that one stack up for you?
So we love small caps, just full disclosure here. And the key reason for that is we believe lower interest rates. Not only do we think we've got 2 quarter-point cuts this year, we think we've got another 4 quarter-point cuts over the course of next year. The funds rate by the end of calendar 26, we think the upper band is going to be at 3%. If we're right, that suggests that you've got an excellent backdrop for small cap stocks as well as those consumer cyclical areas. So that's our longer term view. But there's a lot of noise and nonsense that we're going to have to parse through over the course of the next several weeks.
Given the fact that this would be the deepest rate-cutting cycle outside of a recession ever in data going back to the 1980s. I mean, this is something that a lot of people have pointed to. So do you see these cuts coming irrespective of whatever economic data that we get. In other words, you can question the politics of the moment, but what this market seems to be pricing in is rate cuts for the sake of rate cuts that juice growth and possibly inflation, regardless of the economic data.
Great point, Lisa. We're looking at that dual mandate. We're looking at the data. And so while there is some concern about inflation, we're focused on the labor market here. What's happened in the labor market over the last three months? The average non-farm payrolls, 35,000. The first 4 months of this year, that number was up around 125,000. All of last year, that number was 168,000. So the labor market is materially slowing. This coming Friday, we're going to get the August non-farm payroll report. The August report, historically, is the wonkiest report of the year. There's going to be a lot of noise. You know, you've got summer vacations in and out. Companies, manufacturing facilities take downtime in terms of furloughing temporarily workers and whatever. And then next week, I think it's next Tuesday, we're going to get the annual payroll revisions. Last year, that revision was down 800,000 jobs. We think the revision this year could be down another 500,000 or 600,000. So we'd be focused more on the labor market and the deterioration there as opposed to what's going on with inflation.
If inflation is higher, though, and you do see that sort of crimping in the labor market, the sort of loosening or in the labor, I should say, this issue of people not being able to get jobs, then why would small caps rally, which are typically hinged to growth, when that's a stagflationary backdrop?
So we think that growth ultimately over the course of next year is going to improve. Let me throw this data point out. Our macro policy committee at Federated, our GDP forecast for next year is 2.8%. The blue chip consensus is 1.4%. Within the blue chip consensus, the highest estimate on the street is 2%. So why are we at 2.8? One of the things we're focused on is the fact that we are looking for a significant improvement in economic activity coming in corporate capex. One of the key provisions in the One Big Beautiful Bill was 100% expensing. So you look at productivity growth in the first quarter of this year, and it was negative by 2%. It's never negative. What we think was happening is a lot of companies were holding back their capex plans, saying, we're going to wait to see what's in this piece of legislation.
Okay, but that was also contingent on some clarity around tariffs. Don't some of those plans get withdrawn now that there's a real question mark around how much the tariffs go into place?
Well, the tariff question is an open question at this point. And so I think legislatively we've got that, but I think this is ultimately going to be decided by the courts, particularly the Supreme Court, in terms of the legality of the tariffs.
Despite that, you're clearly looking for a reacceleration in growth through the next year.
Absolutely.
And arguably the market's picking up on that in the last month. Do you think what's happening at the long end of the yield curve is a reflection of a better growth profile in our future? Or do you think it could become a constraint for risk assets?
So the way we're looking at the yield curve is you're probably going to see a further steepening, lower interest rates at the low end, higher interest rates at the high end. But as we look out over the course of the next 18 months or so, we think the benchmark 10-year Treasury yield could be working down towards the 4% level, which is supportive, we think, of consumer cyclicals and smaller cap stocks.
What's helping 10s fall? What do you think delivers that outcome?
Well, I think the reality that inflation is not going to be as significant a problem as some individuals are pricing in now. We think that, again, as we're looking at this Phillips curve trade-off, the thing that we'd be focused on is the weakness in the labor market. Yes, there's been a little bit of a tick up in inflation, no question, but we're down off of a 41-year high to a 4-year low. There's been a little bit of a tick up, but we don't think we're going back to, a 9% CPI level over the next couple of years.
So basically the steepening yield curve is just bond traders getting yippy, and that they will stop being so yippy and everybody will come back and it will just go back to something that seems more stable?
Things will calm down over the course of the next couple of months.
Some of the chief strategists from the White House.
Well, that's sort of what it seems like. I mean, it's sort of these momentary freakouts by bond traders that come back to work and think, oh, my goodness, these headlines are concerning. This is it. This is the big moment. And then they get kind of cowed into reality.
Well,
and
they've been lying on a beach for a month, and today's the reality call.
Oh, yeah, I can see all the
There is something unsettling, though, about the very long end of the curve. The fact that the DMO in the UK, for instance, has to come out and basically say not much appetite for the long end of the yield curve, seeing a similar thing play out in the US. Likewise in Japan. France has got its own problems. I get that. But they all contribute to the same thing, a reluctance for a lot of investors to buy at the long end.
How do you invest in the programs of a government that can't even stay together for 6 months? And that is the conundrum that a lot of people have for European, for developed market governments. This is really the ultimate question. Are developed markets losing their clout on the global bond market stage, and how much does that crimp their ability to support their budgets that they've been having for the past 30 years?
We mentioned this just last week, going into the weekend, the conversion of EM and DM dynamics over the past 12 months. Pretty notable.
Yeah, it was a great point that you made, and this was really what ultimately is going to come to fruition here. How much are countries losing the ability to gain control of the narrative at a time where it's kind of getting away from them from both the currency perspective and the bond market perspective?
Bonds down, yields up by about 5 basis points. Stateside, the 30-year at about 4.98. Phil Orlando, Federated. Phil, good to see you, sir. Appreciate it. Thanks for dropping by. Let's get you an update on stories worldwide with your Bloomberg brief. Here's Yahara Arnott. Hey, Yahara.
Hi, John. Klarna is looking to raise as much as $1.27 billion in its highly anticipated U.S. IPO. It plans to sell 34.3 million shares in the IPO, with the price expected to be between $35 and $37 per share. The buy now, pay later firm will trade on the New York Stock Exchange under the ticker KLAR. Meanwhile, it's an underwhelming start for Tesla in India, with just over 600 orders since its sales launch under 2 months ago. Heavy import tariffs have pushed the cost of Tesla's entry-level model above 6 million rupees, which is about $68,000. That's much higher than the 2.2 million rupee price tag of most other EVs in the country. And we are on to the round of 16 in the 2025 U.S. Open after number 23 seeded Naomi Osaka took down the third-ranked Coco Gauff in straight sets. This marks Osaka's first quarterfinals since 2021. On the men's side, favorites like Jannik Sinner, Carlos Alcaraz, and Novak Djokovic all advance to the next round with ease. That's your Bloomberg brief. John?
Yahara, thank you. Appreciate the update. More from Yahara in about 30 minutes' time. Up next on the program, a tariff roadblock.
We think we're going to win at the Supreme Court. We are close to a tipping point where we could have financial instability due to these large and persistent trade deficits. So we are trying to head off a crisis.
Up next on the program, we'll catch up with Henrietta Treyz of Veda Partners, live from New York City this morning. Good morning. A really decent run over the past 4 months. 4 months of gains on the S&P 500, with much more of a cyclical tilt through the month of August. Waking up in September, though, reality check from the bond market. Stocks down by 0.7% on the S&P, on a Russell by 1 percentage point. And here's your reality check. Slap round the face from fixed income worldwide. 30-year bond yields up by 5 basis points, 4.98 this morning on 30s. Highest since 98 in the UK, highest on record in Japan, highest since 2011 in France.
The why is interesting here. How much is this a fiscal concern issue? The question of how sustainable a lot of the budgets are around the world. How much is this an inflation issue? And how much is this just a protest issue? The bond vigilantes with pitchforks, and ultimately that will drive what the meaning of this is. You asked Phil Orlando a great question. Is this yield curve increasing or widening a sign that growth is going to accelerate, or a sign that inflation is going to get out of control? And he's saying, it'll normalize, right? But that's really the key question at a time where it could be viewed positively or it could be viewed very negatively.
I think what a lot of people find unsettling, myself included, is the loss of confidence in the long end of the yield curve. And we've seen bout after bout of that through the year so far. And you're not just seeing it in the United States. That's problematic. You're seeing it across DM. And I'm not sure there's much that governments in the UK and France at the moment seem to be able to do about it. We know what the recipe is. We know what the to-do list is. They just don't seem to have the ability to actually follow through anytime soon.
The bond market is almost like a gauge of the dissolution of the global world order. And there's been this feeling that governments in democracies around the world can't bring the poles together. And you've seen that in France, you've seen that in the US, you've seen that in the UK. You cannot bring the two very polarized sides of the political spectrum together. So what do you get? A bond market that's not having confidence 30 years out that government's going to have the ability or willingness to actually pay back their debts. And that is what you're seeing increasingly priced into bond markets.
Wouldn't call it a buyer's strike just yet. Wouldn't go that far, but you've seen signs of it, that's for sure, for the year so far. Under surveillance this morning, a tariff roadblock.
We think we're going to win at the Supreme Court. We are close to a tipping point where we could have financial instability due to these large and persistent trade deficits. So we are trying to head off a crisis.
So here's the latest this morning. More uncertainty over the future of Trump's global tariffs after a federal appeals court ruled most of the levies are illegal. The tariffs are allowed to stay in place while the case plays out. With the latest, here's Bloomberg's Tyler Kendall. Morning, Tyler.
Yeah. Hey, John. Good morning. So these are the tariffs that were invoked under IEEPA, the International Emergency Economic Powers Act, and the court ruled that President Trump overstepped his authority here because under IEEPA, the president had to declare a national emergency that the administration felt warranted a tariff response. So in the case of the so-called reciprocal tariffs, the president cited persistent global trade imbalances. And in the case of those tariffs against Mexico, Canada, and in part China, the president cited concerns around the border and fentanyl. And I would expect these to be the arguments that the White House really highlights in the coming days as they prepare to likely take this to the Supreme Court. Now, I think it's worth mentioning that courts have historically been pretty deferential to a president's ability to declare a national emergency, but we have never seen a White House invoke IEEPA in order to impose tariffs, and let alone them be this wide-ranging. So this really does appear to be perhaps some uncharted territory. Now, as you mentioned, these tariffs are allowed to remain in effect while this works its way through the court system, and I don't need to tell you that trillions of dollars are tied up in the decision. In fact, if the Supreme Court were to uphold it, the Committee for a Responsible Federal Budget estimates that 71% of projected tariff revenue for this year would all but vanish. Now, with that said, John, of course, we're not expecting tariffs or the revenues that come with them to really go away. A person familiar tells us here at Bloomberg News that administration officials are already preparing other federal authorities to enact tariffs, even as they plan to appeal this decision. That could mean everything from more Section 232 investigations or the Treasury Secretary Scott Bessent saying over the weekend they're looking into Section 338 under the Smoot-Hawley Act.
Tyler Kendall with the latest in Washington. Tyler, thank you. This is why we've been asking a question on this program. If this was struck down, would it be bond positive or bond negative, given how much money has been raised?
Yeah, given the fact that that wouldn't be plugging the gap in the federal budget deficit that a lot of people were expecting, and people are recognizing that a little bit more this morning than some of the other potential consequences.
Do you think, just on the margins, this is contributing to what we're seeing in America in the bond market this morning?
You know, Sure. I mean, maybe you could see that as saying maybe that's the case, but it's not being led by the United States. And that's the one caveat, because you're not seeing the extremes in the U.S. bond market that you are in the U.K. and in Europe. So while I'd like to say, yes, that fits a neat narrative, I can say I really cannot explain it fully.
It's a global bond market move, that's for sure. To weigh in on some of this, Henrietta Treyz, the Director of Economic Policy Research at Veda Partners, joins us now for more. Henrietta, welcome. A lot of people just assume this will arrive at the Supreme Court, and this administration assumes that ultimately the Supreme Court will side with them. Is that how you see things playing out?
It would require a whole lot of fiscal dominance and migrating that fiscal dominance strategy away from the Fed and onto the Supreme Court. Not that he can't do both at the same time. But the reality of the situation is that the Court of International Trade found unanimously that these tariffs are unconstitutional and illegal. The Court of Appeals found the same thing on Friday night. The Supreme Court generally would not even take up this case. This is obviously political pressure coming from the administration trying to insert itself into the Supreme Court of the United States. And while Bessent might be optimistic that they're going to prevail, we hosted a conference call with international trade lawyers who've argued in front of the Supreme Court on Saturday for clients, which came out to 65% odds that the administration is going to lose this case. So as Tyler points out, prepare to migrate to sectoral tariffs. Expect much more of them on 232, 301, across the board.
So let's talk about what that would mean in terms of revenues. You said that even with those sectoral tariffs, if you took away the tariffs implemented under IEEPA, that would reduce revenue collection to the U.S. Treasury by $2 to $3 trillion at least. Can you sort of expand that out to give a sense of how much this kind of sends Congress back to the drawing board when it comes to reducing the federal budget deficit?
Yeah, and I heard your last commentary about whether or not the bond markets are paying attention to this. In my experience, they absolutely are. I was in a lunch room in New York with 20 investors just this time last week, and it was really clear that repealing these tariffs is going to be a massive problem for the bond market. And so you're really going to have a tale of two responses with the market, one for the bond market and the other for the retailers who are dire impacted by these tariffs, whether it's 25% on India for the reciprocal rate plus 25% for their purchase of Russian oil and gas, whether it is the 50% tariffs on Brazil. I mean, these are all exhaustive and imposed directly on nations that cannot be replaced quickly with 232s or sectoral tariffs. Just think of India, Vietnam, Malaysia, the Philippines. Those nations have a 20%, 19% IEEPA tariff rate, but then they also have a 40% IEEPA tariff rate. That's everything coming in that you're buying at Walmart. So it's a huge boon for those names. But the bond market that's still struggling with the fact that earlier this year, the Republican conference passed the most expensive tax bill in U.S. history, and we did not pay for it. We cut 12 million people off of Medicaid, but that's not enough. We need a lot more revenue, and the tariff revenue is what's keeping the bond market together. So stripping IEEPA tariffs, while beneficial to Walmart, is going to be a disaster for the bond market. And I think that's what people are pricing in right now as they come to grips with the fact that the president could lose this authority at the Supreme Court by the end of the year.
Henrietta, John pointed out that earlier this year, when some of these tariffs were first implemented, it was considered a negative for bond markets. And now the removal of said tariffs is considered a negative for bond markets. What about the argument that the reduction of these tariffs will cause an increase in growth, an increase in trade that will foster an increase in tax revenues just by virtue of how much money companies and individuals are making?
Yeah, absolutely. I mean, it's wild. It's unbelievable to watch the market correct 12% on Liberation Day and then respond negatively when the tariffs start to come off. And it's because we started baking in this idea that just because inflation hasn't hit yet, and just because we're only down 116,000 manufacturing jobs and job growth is stagnant, these tariffs are somehow a good thing. It's completely counterintuitive. There's going to be a lot to shake out in the market. It is highly political, and that's what we're dealing with.
Henrietta, appreciate your take. Henrietta Treyz there of Veda Partners. One common theme: policy uncertainty, both in April and here again coming into September.
Well, I just wonder how much this really supports or rejects the bull case scenario that Stuart Kaiser put out over the weekend, where he was talking about, well, companies are finally going to have the confidence to implement all of their spending plans. Well, can they have that confidence? Is there more clarity? I mean, maybe there's more clarity than on April 2nd, but do we really have a sense of what the structure of tariffs will be? It seems like that might be a real question.
What did he call it? The sneaky bull case?
Yeah, I mean, it's
the sneaky bull case for year end.
Is it still sneaky, or is it now getting sleepy and pushing to the side?
It's getting sleepier.
Yeah.
Put it that way.
I don't know if that works.
Big move in the last month. Small caps up 7%. In just a moment, we'll catch up with Matt Maley of Tabak following the best month for small caps so far this year. Plus, Danny Berger with your morning movers. We'll catch up with Danny as new data reportedly shows fewer Amazon Prime sign-ups despite expanded sales. That stock is down by 1.4%. From New York, you're watching Bloomberg TV. Let's check out some moves. Early days, I know, early in the month, but this is how we're kicking off September. Equities down across the board by 0.75% on the S&P. Outperformance for the small caps in August. Underperformance this morning. Up by 7% last month, down 1% so far today. In the bond market, 2-year, 10-year and 30-year bond yields higher by 5 basis points on 10s and 30s. The 30-year bond yield inching closer to 5%. 497.48. Worth repeating once again, it's not just a move here stateside, it's a move worldwide. You're seeing it in the UK, in France, in Japan. But a move I wanted to pick out was what was happening with gold. The takeaway from Chairman Powell is that Chairman Powell is much more sensitive to what is happening with the labour market, much less sensitive to what's happening with inflation. And I think there's another way to frame the second point. More tolerant of above-target inflation is a takeaway of a lot of people right now, and that speaks to the 5% move we had in gold just last month.
What is the haven trade if you can't count on stable inflation and a fiscal policy that is just as dependable as it's always been in the United States? You've seen gold increasing as an allocation for sovereign wealth funds around the world because of this question. Gold reaching all-time highs. more than 3,500 as people look to that alternative and finding it in the precious metal.
I think it's up 30% so far this year,
Bonkers.
Which is just absolutely remarkable. Up this morning by another 1/10%. That's the price action in precious metals with 2 hours until the opening bell. Let's get you some morning moves and cross over to Danny Berger for more. Hey, Danny.
Hey, John, if you just look at the biggest movers to the downside, there's an outsized presence of tech, a repeat of what we saw Friday. Nvidia on the lows of the pre-market session down 2.33%. If it continues to decline, it will be its fourth consecutive day of declines, the longest losing streak since March. Take your pick of why this is happening. Higher bond yields, as you were pointing out. Alibaba unveiling a new AI chip, some bad earnings from other AI players. Regardless of the reason, there are clearly some market jitters around this. Now, elsewhere, another big tech Mag 7 declining today is Amazon. Shares are down 1.5%. A Reuters story out moments ago that sure, Amazon touted its really strong Prime Day sales, but it has one internal metric of how many people sign up to Prime in the run-up to Prime Day, and that declined. That missed the mark, lower by about 2% than what they expected, so that also seemingly have an impact here. Elsewhere, some activist action. The Wall Street Journal reporting that Elliott Management has taken a stake in PepsiCo, a $4 billion stake. This would be one of Elliott's biggest ever. It says that it wants to have some changes at the drinks and snacks maker, given they're struggling, losing market share. It doesn't detail what those changes might be, but still shares up 4.5%, John.
Danny, thank you. Big move. More from Danny in about 60 minutes' time. On our radar this morning, leaders from China, India and Russia signaled unity at the Securities Summit in China this week. The three nations tightening diplomatic ties in response to President Donald Trump's sweeping global tariffs. The president saying India is offering to remove all tariffs on U.S. goods after imposing 50% levies on New Delhi for buying Russian crude. Trump calling trade relations with India, quote, a totally one-sided disaster.
And then going on to say it's almost too late. So you wonder, is there room for negotiation? You wonder if those two stories are related, if the image of Modi, Xi and Putin getting together, holding hands, giving each other hugs, giving each other claps on the back and saying, yeah, let's be partners, whether that actually did get the president thinking, OK, maybe we need to do something a little bit different here. I don't know. But it really is questionable, especially at a time where the leverage has been taken away, given the court ruling about pausing, at least, if not stymieing the IEEPA tariffs.
The president trying to drive a wedge between a few of those individuals in those pictures, and ultimately it's not working. India is not backing down over buying Russian crude.
Well, the truth is, what incentive do they have to do so if they're going to be penalized from the tariff perspective? And it raises the question, is this the beginning of a true outreach, or is this sort of a one-off, maybe we can negotiate something if you remove all the tariffs? Ultimately, this just adds to the slew of uncertainty that we've seen with respect to what the tariff regime is going to be and what this administration is signaling when it comes to just how much they want certain alliances versus others.
Well, let's talk about taxes, trade and what's happening in this bond market. This is the latest from the Treasury Department, sharing with Axios a list of 68 jobs that are eligible for President Trump's no tax on tips promise. The list includes waiters, bartenders, golf caddies and home electricians. Just a reminder of that massive bill that's been passed, and maybe some of it's shown up in the bond market just a little bit this morning.
OK, I went through this list, and first I was thinking, OK, so does this mean that people, when you go get a pedicure or manicure, let's say you're getting a manicure, can you now tip with a credit card, and is that just as good as tipping in cash? Because that's ultimately something that they all say. I'm just saying, personally, that's something that I've noticed. But how many of these people actually paid taxes on this? How many people actually meet the threshold to be paying taxes versus either breaking even or getting money back? I mean, that's really the question. How many bartenders, I mean, I guess if you're at a high-end bar, but really are making like, three-digit figures, these are the questions that I was asking as I went through this.
We don't know, because how much of the earnings were actually disclosed?
That's a great question.
Over the past few years. In fact, the past several decades. How much of the earnings were actually disclosed?
I assume that gambling dealers and gambling cage workers did really well with their disclosures on their tax forms. That's my suggestion. That disc jockeys, if you're a disc jockey, you're good. I was going through this, and you just wonder how much was actually reported, how much do these people cross the threshold for actually having to pay extra taxes, and how much will this really shake the needle? I don't know.
It's hard to know. It's hard to know. I'm with you, but we're losing an offset potentially. And I stress potentially. The offset was going to come from the tariff revenue. And now there's just a little bit of uncertainty around that. I still believe the consensus on Wall Street is that the legal proceedings will continue, that the president will ultimately succeed in the Supreme Court, and these will stay on. But just that uncertainty enough to cause some jitters maybe stateside.
Yeah, and if you are into being a plumber or if you're doing home maintenance, then you can keep those tips. That actually could be the area that could be most lucrative. I'm just thinking about careers for my children when they graduate. That seems
you're
like
focused
a more lucrative.
on that.
I think
Okay.
it could be a more lucrative career than, going and working in an office these days, because that seems like it's less reliable.
I think there was a report, was it from Stanford?
Yes,
in
it
the
was
last
Stanford.
week
Yeah.
on AI and jobs for the entry-level work. It's already been damaged, already seeing them held back.
Massively, because they can just replace them with AI, especially if you're a computer programmer. So if you're going to be in computer programming, even medicine potentially has a disruptive factor. But if you're a plumber, you can keep your tips and you can go out there and you can get a job much more easily. And that's actually what we're seeing in the data.
And there's your pitch from Bramo. We'll get more jobs data later on in the week. We'll get JOLTS, we'll get ADP, we'll get the big one, payrolls, on Friday. Let's turn to markets. Matt Maley, Chief Market Strategist at Miller Tabak, is cautiously optimistic on the Russell 2000's recent outperformance, writing the following: the potential for the small cap sector of the stock market to finally outperform for more than just a few weeks is definitely growing. Matt joins us now for more. Matt, welcome back, sir. Let's talk about it. 7% move in the month of August. Let's talk about what underpinned that move and why you think maybe this can continue.
Well, it's going to depend, obviously, on a lot of things, and we have this situation suddenly cropping up in the bond market. But the whole thing, though, is that everybody's kind of focused on what's happened with the tech stocks. They've had this unbelievable run. Do they take a little bit of a breather, and do we see a rotation? And we are seeing that recently, and we're seeing it rotate into the small cap sector. And if the economy can hold up and doesn't roll back over or slow even more, this is let's face it, the market is incredibly momentum driven. And you have the Russell 2000 now not just getting close to its all-time highs from last year, but that all-time high is actually a double top high from 2021 and last year. You break above a double top high, that's going to create all sorts of positive upside momentum and attract a lot of that momentum flow into the market.
Matt, it's the inflation piece of this that gets my attention. Gold at record highs, big move also through the month of August. What's the relationship between, say, small caps, what we've seen in precious metals, and what might happen with inflation over the next year?
Well, I mean, the thing about inflation, I guess the whole thing I'm concerned about with what's going on with gold is that it's becoming the only risk-free or flight to safety trade. I mean, we've seen that the cryptocurrencies haven't worked as well, and of course, the bond market. That's if inflation's going higher, that means the yields are going higher. And I guess maybe the biggest concern I have about this whole scenario that maybe the small caps can outperform is what you're talking about on global interest rates. We're seeing it in Europe, Japan, et cetera. But a lot of that doesn't just have to do with inflation. It has to do with concerns about budget deficits and fiscal spending, et cetera. And if we can't make up for some of these losses we get on, some of this revenue that we lose from tariffs or whatever, we're going to have a big. I guess what I'm trying to say is that we have to be very careful. We're moving to this month of September. Watch those interest rates. If they move higher, it's going to be a big problem.
So you think that could potentially curtail the momentum that we're seeing in small caps if you see long end rates go higher, even if you see short end rates continue to decline. Is that right?
Yes, and one of the things two things. Number one, on when it comes to you were talking with the previous guest about the yield curve. And the yield curve, people like, those old days when inverted yield curves signal a recession, we don't have to worry about that anymore. But it was actually never that. It was only when the yield curve not only goes from inverted back up to positive, but when it gets to 50 to 60 basis points, as it is getting now. That's usually what signals a slowdown, a significant slowdown, or even a recession. That's not good for small cap stocks. And then, of course, the other issue is that when we have the situation where the economy, we go back to the earnings growth, and we could talk about that. But the earnings growth that we're seeing right now, although it's good and it's solid, it's good and solid for a stock market that's up, that's trading at 17 times earnings, not one that's trading at 23 times earnings. So again, we have a lot of headwinds we're looking at right now. So I'm saying that the odds are growing that we'll see some outperformance of the small caps, but it's definitely not a lock, and we have to wait to see how things play out over the next couple of weeks.
Are we creating narratives to try to be bullish on all of these stocks in the universe as a result of a very bifurcated market where you have a sea change in artificial intelligence driving a massive increase in market cap of just a handful of companies. And people are saying, okay, they're looking pretty expensive, those 10 stocks that account for about 40% of the S&P 500 now. But, that dynamism can be carried out to other names as well. Are people getting ahead of their skis, over their skis when it comes to that kind of mentality and then trying to find other reasons to justify that?
Lisa, I definitely think that's part of the case. And we look at what's going on right now. We're seeing some more raising of price targets on the S&P 500. Well, that people were tripping over themselves to do that in January, just before the market went down. And people were tripping over themselves to cut their targets in April when the market was making a bottom. Now we're kind of seeing the opposite tack. But what it comes down to, though, which when you talk about, we're looking for that broadening out. People are desperately looking for that. But we have to remember that this is still a tech-driven market. And if the tech stocks trade sideways or even trade slightly higher but lag a little bit, that's okay. We can see a rotation. That's what we saw in January of this past year. January of this year. But if tech stocks start to go down, they're much too highly weighted in all the major indices for those indices not to go down. And I'll tell you, if those indices start to go down, the whole look of rotation is going to disappear. People are going to rotate into cash because we've heard all this talk about bubbles and the September-October timeframe. People are going to start pulling money out of the stock market. So if the AI situation starts to fade, and of course we had that that report from MIT a week or so ago talking about how so few companies are making money from this. And then you look at what's going on with NVIDIA, reported good numbers, but not so good. But whenever NVIDIA rolls over after reporting earnings, like it seems to be doing right now, that creates headwinds. So again, no matter what we talk about small caps and rotations and things, and everybody's hoping for that, you got to follow the tech stocks. If they go down, the market's going to go down, and the money's going to come out of the market. So we're definitely heading into this seasonality issue that is starting this morning in a rough fashion. We'll see if it continues that way.
They're going down this morning. Matt, appreciate your time. Matt Maley of Tabak. We're down about 1% on the Nasdaq 100. Speaking of new price targets, this from Julian Emmanuel of Evercore. New price target for year-end next year, year-end 2026, 77.50. On the S&P 500.
Yeah, the once-in-a-lifetime opportunity that he sees in AI, and this is what's driving him to see, even if there are some dips or some volatility, which people have been expecting last month, but might just be delayed, that will still lead to a much higher market on the heels of AI, which could be true. It's just a question of participation. Does everyone get to participate in that game?
Getting one of those dips this morning, just a little bit softer. We're negative by 0.8% on the S&P 500. With an update on stories elsewhere with your Bloomberg Brief, here's Yahira Arnold. Hey, Yahira.
Hi, John. Food giant Kraft Heinz plans to split its business into two companies in an effort to streamline operations, provide greater resources to individual brands, and drive profit. One company will include its sauces like Heinz ketchup and boxed products like Kraft mac and cheese. The second will sell grocery products like Oscar Mayer hot dogs and Lunchables. The transaction is expected to close in the second half of next year. Meanwhile, Treasury Secretary Scott Bessent said the Trump administration may declare a national housing emergency this fall. He declined to list any specific actions, but Bessent told the Washington Examiner that housing affordability would be a critical leg of Republicans' 2026 midterm election platform. And New York Democratic Representative Jerrold Nadler, the former House Judiciary Chairman, will not seek re-election next year, ending his 34-year congressional career. Nadler helped lead President Trump's impeachments, and he told the New York Times that at 78, he wants to respect the need for a generational change in the Democratic Party. That's your Bloomberg Brief. John?
Yahira, thank you. 34 years later, 78 years old, respecting the need for generational change.
It's better late than never, I guess. But it does. Honestly, this will be a real question, though. We have seen retirements. How much are people going to push back? What does that new generation of leadership look like? That's the key question.
Well, from that party, further and further to the other extreme.
Well, this is what we've been talking about. We've seen a polarization increasingly on both sides of the party, and we've seen this globally. So who brings that together? Does anybody, or is this just sort of the way to go in the future?
How interesting is New York politics right now?
It's pretty interesting.
Right?
It would be nice if it were a little more boring.
It's going to get more interesting in a few months' time. Up next on the program, I'm right there with you. A warning sign for financial markets.
It is a warning sign, and we have seen governments react to this sort of warning signal. That's just something we need to be a little bit careful of, not to mix signals here.
We'll catch up with Matt Hornbach of Morgan Stanley in just a moment, live from New York City. You're watching Bloomberg TV. Equities down here by 0.8% on the S&P 500, negative on the Nasdaq by 1 full percentage point. Under surveillance this morning, a warning sign from financial markets.
It is a warning sign, and we have seen governments react to this sort of warning signal. Donald Trump himself clearly has reacted to that sort of warning sign before, and we have to be careful not to conclude right away that if the bond yield rises, that automatically translates directly into much, much higher spending on interest payments. That's just something we need to be a little bit careful of, not to mix signals here.
So here's the latest this morning. 30-year bond yields inching back towards 5% as bond yields worldwide continue to climb. Matt Hornbach, the managing director and global head of macro strategy at Morgan Stanley, writing, with Fed rate cuts approaching, we expect both Treasury yields and the US dollar to make new lows in the fall. Matt Hornbach joins us now for more. Matt, good morning.
Good morning.
It's good to see you in person, buddy. Thanks for dropping by. Been following you, the team, Mike Gapin, your calls on the Federal Reserve. So now looking for a cut in September. But I think you make an important distinction. A risk management move versus something much larger and deeper over the next year. Can you just explain that just a little bit?
Yeah, absolutely. Well, we are expecting the Fed to restart the easing cycle this month. And the reason is not because we're on the precipice of recession. It's really about trying to avoid us being on the precipice of recession. And so the way that you do that is you begin to once again reduce the amount of restraint that the economy is dealing with in terms of short-term interest rates. And the idea there is, of course, as you start to lower short-term interest rates again, those longer-term interest rates, which have not been going down very much, will start to follow. And of course, this happens both with a steepening of the yield curve, which is what we've seen. But as the yield curve steepens, it actually increases the incentive for levered investors to put money to work further out the yield curve. And in doing so, you then start to see those long-term interest rates move lower as well. And that's really what's important for the U.S. economy, is getting those long-term interest rates to begin to trend lower, not just move lower in a given month, right? We want these interest rates to be trending lower. And without rate cuts, it's hard to see that happening.
The flip side to all of this is that maybe the Fed's going too soon. Inflation target is 2%. Inflation's running well above that. And that perhaps we just heard from a Federal Reserve that's more tolerant of inflation. And for that reason, hands off, don't want to buy the long end. How would you push back against that view at the moment?
Well, it's hard to push back against that view at the moment because that's what people are talking about. And oftentimes the narrative will drive the price action. So it is tough to push back against that in this moment. But we need some more inflation data to really understand where is the locus of inflation today. Is it in the tariff-related sectors? Is it in services? This last inflation report showed hardly any signs of tariff-driven inflation. It was mostly in the service sector. Core PCE, which we got last week, goods inflation was 0. So it's really hard to look at the inflation that we're getting and cry foul about tariffs. We think it's coming, but we have thought it was coming for several months now, and it hasn't shown up to the extent that we thought it would.
You suggest in the argument something that John's been raising for a while. At what point will weakening economic data not push people into long-term treasuries, but have the opposite effect, right? The idea that if the economy isn't strong enough, that questions how much the U.S. can really increase the revenues at a time where they're going to need to increase spending, which will lead to more inflation, bigger deficit, higher yields in the long run. I mean, at what point do we reach that kind of doom loop that we're seeing the U.K. flirt with?
Yeah, I tend to think about these doom loop concepts as relating more to the currency than to longer term interest rates. It's been, I think, a very long time since we've seen investors abandon the long end of the yield curve when the economy is going down the tubes. I just haven't seen it, at least that I can remember in 25 years. But you can't say the same thing about the currency. And so if we were to get into a situation where the economy hit recessionary territory and the Fed had to lower interest rates much more aggressively, that would be an environment where I think you would see interest rates across the yield curve decline, led by the front end of the curve, of course. But at the same time, I think you would see the U.S. dollar depreciate. And that's more or less what we're forecasting. We have interest rates going down and the dollar going down simultaneously.
If that's the case, why not buy 30-year bond yields, 30-year bonds over in Europe, and just buy them for the absolute, given the fact that you expect currency appreciation relative to the dollar, as well as potentially maybe a stabilizing?
Well, I think for long-term investors, that's a great trade, no doubt. But when we talk about investment strategy, unfortunately, we have to be a bit wonky, right? We have to talk about both what we are recommending real money investors to do with their cash and then what we recommend levered investors to do. And the yield curve in the U.S. is a great example of this. If you're a real money investor and you're really going for total return, the long end of the yield curve has great value. Real yields at 2.5% in the very long end of the curve, that's great value. That's where you should be putting your money if you're a real money investor. If you're a levered investor, meaning you're borrowing money in the short-term interest rate markets and then lending it long, it's better to be in the short end of the yield curve because from a levered perspective, that's where I think you make most of your money.
Matt, important distinction. Matt Hornbach and Morgan Stanley. Good to see you in person. Once again, got to do this more often. It's been a long, long time.
Pleasure to be here.
Thanks for dropping by. Appreciate it. As we pointed out a few times already this morning, this dynamic that's playing out so far today is not just in America. You're seeing it in the UK and France and Japan and elsewhere. The move in the UK, both in the bond market and the currency, of the utmost concern, I think, going into this budget for the Brits in a few months' time.
Yeah, the highest 30-year yields going back to 1998 at a time where there's a real question about how much money they can raise through the taxes lever, given how many people, as you point out, have been leaving the region, and how much they actually have the willingness to cut budgets at a time of public outcry, and we've seen that in France. So this really is the conundrum.
I'm pleased you used that word, Bramo, because you're dead on. The willingness. They've got the ability, they've got the majority in Parliament. They just haven't been willing to make the spending cuts that need to happen. There's been pushback from their own party.
Yeah, so this is the issue. Do they take the political heat? And if they don't, does the bond market give them the political heat?
There are consequences. Yields up by 6 basis points and the currency a whole lot weaker. Coming up in just a moment, Judy Biel of Kayne Anderson Rudnick will catch up with Ken Hoexter of Bank of America, Erin McLaughlin of the Conference Board, and Kathy Jones of Schwab.
This is an environment that is very volatile.
In general, things have been drifting more positive.
Yields still look elevated versus where they've been.
Our long-term outlook for the equity market is that the returns are going to be lower than they have been over the prior 5 or 10 years.
Everything is expensive right now. And I think we should expect lower returns across the board, both from stocks and from bonds.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores look like this. Stocks down, bonds down. Equities lower by 0.8% on the S&P 500. Bond yields higher on a 30-year bond this morning, approaching 5% stateside. Your yield, 497.27. As we work our way through the week, tons of economic data, including ADP in a few days' time, and then the big one on Friday. Payrolls Friday just around the corner.
And what is the market lining up to respond to some of this data? Is good news, good news? I know that Stuart Kaiser is shaking his head, but this really is the question. If you get better than expected data, what does the Fed do with that? Do they still cut rates this month? If they do cut rates, do people start to worry about inflation? And on the flip side, how punitive could the markets treat a negative number or something that really is thought of as really weak, given already some of the concerns about the dollar and concerns about the fiscal backdrop?
So this is how I'm thinking about the data at the moment. I think it's rate cut on for September, whatever. Would take something massive to change that story. The debate of the Federal Reserve is what to signal beyond that. What comes next? That's where Governor Waller's speech going into the weekend becomes, I think, increasingly important. When he says, let's get on with it, was literally the title of the speech. Everything in it from there is about what you do once you've started. And he started to signal more cuts beyond September. Is this committee prepared to go along with that, or is September still far too soon?
This market is going along with it, and this market is pricing in the greatest number of rate cuts through the end of next year that we have seen outside of a recession in the United States going back to the 1980s. So if that is true, does that come with no consequences? Does that come without the inflation that some people worry about? Or do we have to think about what that means about a tolerance of higher inflation in order to prompt growth? And that, I think, is what the market is grappling with around the world, with yields going higher.
Seeing in precious metals, gold record highs up 30% so far this year, up 5% last month. Are you seeing it at the long end of the yield curve? I think in some cases you might be. Just a little bit of pushback from the bond market too.
Yeah, and this has to do with inflation, and it also has to do with just credibility in the fiscal backdrop over the next 3 decades. I do wonder, we talk about gold at record highs at almost $3,500 an ounce. You wonder what happens if you start to see something like Peter Scheer suggested, yield curve control. If the Fed starts to say, we're concerned about the yippiness, the 30-year, we're going to try to control it, buy some bonds, try to get that down. Do you start to see gold prices go even higher? As a lot of investors around the world think of government bonds of developed markets as not being the haven that they have traditionally been.
Danny mentioned this last week, and Danny's right to bring this up. The transmission of monetary policy, is it being disrupted? Are you dropping interest rates but not seeing an easing of financial conditions? Now, here in America, that would mean lower mortgage costs, and that would mean lower yields at the long end of the curve. And is that a reason, a justification to step in at the Federal Reserve? And I'm not thinking about this Fed. Forget this Fed. Chairman Powell, when he offers guidance in September, that's the last guidance you're getting from Chairman Powell. The next time they deliver forecasts, we'll know who the next Fed chair is, and we'll be far more interested in their guidance for 26 than his. And I think it's the next Federal Reserve, the next iteration of this Fed, and what they're willing to do and not willing to do with the balance sheet that I think becomes more interesting.
Well, it also becomes more interesting at comparisons with Turkey, because if you have yield curve control in order to transmit monetary policy, what is the goal of that monetary policy? It means that inflation is no longer the preeminent concern. It really is about juicing growth, and that is a very different priority for a Federal Reserve that will require a very different market. And that, I think, is what a lot of people are trying to wrap their heads around. But I think the market has been pretty complacent, or at least not really taking that as a realistic kind of probability, and saying there are enough people who take their job seriously that isn't going to happen.
Bonds down, yields up by 5 basis points this morning, 30s at 4.98. Coming up this hour, Julie Biel of Kayne Anderson Rudnick as we kick off a new trading month. Ken Hoexter of Bank of America as shipping companies face fresh headwinds, and Erin McLaughlin of the Conference Board as we look ahead to jobs data this week. We begin this hour with stocks pulling back from recent record highs. Julie Biel, the chief market strategist at Kayne Anderson Rudnick, writing August brought us a broader market led by small cap, value and the laggards for the market. I think if the employment data continues to hold up, that can continue. Julie joins us now. Julie, welcome to the program. That disconnect that we've been talking about, a Federal Reserve that's worried about a cyclical downturn. At the same time, the equity market is displaying more of a cyclical tilt in the last month. Does something have to give?
Yeah, I think something does have to give. I think everyone is assuming that the Fed is moving to a place of easing, and that's going to make life easier for everyone, including small caps. And there's also an assumption that we've really seen everything we need to see about tariffs. Like, case closed, it's really not a big problem. We don't really have to worry about it, guys. It's not showing up in inflation. And I think most people can really recognize that companies did a great job front loading and doing everything they could to offset tariffs. I don't think we've seen the worst of it. And if they're ruled illegal, that creates problems in the bond market as far as the credibility of the U.S. government for being able to pay back its debts.
Well, Julie, let's start with the bond market then. I'm pleased you've brought this up. Do you think this morning's price action is somehow connected to the legal decision going into the weekend?
I think it's part of it. I do think that there is a recognition that, we set up this budget with the assumption that we were going to be able to plug the hole with the tariffs. And, they've done a great job rolling in. I think there's a real recognition that if we do not have that lever to pull, and we don't seem to have any inclination to be able to do the hard work of either cutting or raising taxes, that really does call into question the level and ability for us to repay our debts. I think we really sort of start to look like that kind of creditor, that friend of yours that borrowed money and under, not great circumstances. And I think that's problematic, and that's kind of where the bond market is right now.
If we do get negative economic data this week, how punitive will the response be in equity markets?
I think it depends, right? Because I'm always like, I agree with you. I'm always like, hey, just curious, is good news or is good news bad news, or where are we right now? I think that right now, the way that the market is levered to interest rates declining, and that really seems to be the place where everyone's focus is, that if we have superlatively good economic data, that you'll see actually a pullback in the markets. I would argue that that's probably a good sign. It's really showing the level of resilience of our economy to handle an incredible amount of uncertainty and a challenging, policy situation. I think it would be positive, but I think for most investors, they're really levered to what's happening at the Fed and what's happening with interest rates.
So if we get negative data, that could end up being positive for small caps because of the potential rate cuts that could come on the heels of it. Is that what you're saying, that ultimately the small cap story is a yield story, and that is the reason why when you see yields higher, that leads to a sell-off like the one we're seeing today?
Yeah, I think that most people have a really strong connection between interest rates and small cap. And some of it makes a lot of sense to me because most small cap companies are borrowing short, and they're borrowing with their banks on variable rates. And so they weren't able to lock in the fantastic interest rates that we as home buyers or large companies were able to do. So they are more economically sensitive and their leverage is more variable. There is benefit to them. But I think beyond that, it's really much more important for small cap is how good is the economy doing, because broadly speaking, it's more economically sensitive.
Well, Julie, let's talk about a couple of names. Ross Stores up 8% last month. TJ Maxx up almost 10% last month. Names that you like. What does that price action speak to?
Well, I think it really speaks to everyone in retail is moving towards where is there good traffic, right? Because traffic is where you could really recognize that a retailer is able to meet what its customers are really looking for. And just like we are hunting for value as investors, if you think of just how price starved we all are, we don't have value anymore with the level of inflation and erosion that we have. Everything that happens in off price, you go into the stores and there's a real recognition, my God, this, at least here I can find some good value, some good deals. And I think what's interesting about off price is most of our manufacturers of retail and general merchandise, they have this incentive to create as much stuff as possible, right? Because that incremental dollar that incremental sale is so high margin. So there's always an excess of goods. And so these retailers do such a great job collecting all of them and then selling them quietly without putting them online. So you have a lot of price discovery, right? Amazon can't do this, right? It's too much price visibility. But, your Ollie's, your Ross, your TJ, you do a great job being able to collect all of this merchandise, and it's structurally protected.
Do you think it speaks to a step down in economic resilience of the consumer that we're seeing those names before?
Absolutely, because it's not just them, right? You see that Walmart is able to really bring in more of the very, very high-end customers. I think that if you look across income spectrum, everyone feels annoyed with how high prices are. I mean, we had the management team of Hermes in our offices, and she just kept talking about value. And for them, value was just look at the quality of our craftsmanship and what you pay for it. And we've only raised our prices mid-single digits, while Chanel has raised them 20 or 30%. Everyone's talking about it, and I think it's just a recognition that we're just starving for any sense that our dollar is worth something.
So is inflation good or bad for small caps?
I think inflation is generally pretty bad for small caps. They've shown themselves less able to raise prices. They don't always have the level of economic control that larger cap companies have, right? They can't shrink down their packaging as easily as Procter & Gamble can. And so they were really hamstrung by what happened early on with inflation. I think they've gotten their footing. They have reset their capital structures. They've reset their cost structures, and they're in better shape. But if we see an environment where inflation really skyrockets, that's problematic for them.
Julie, appreciate your time. As always, thank you. Julie Biel there of Kayne, Anderson, Rudnick. If you're just tuning in, seeing another leg down in stocks, another step up in bond yields. Stocks are down by 0.9% on the S&P 500. Bond yields higher now, Bramo, on 10s at least, by more than 6 basis points.
So how high can they get before something breaks? And can this be the sort of persistent grind higher that we've seen, particularly in the UK, but around the world? In the United States, you pointed to this idea that it could be tied to the idea of tariff revenues not coming in here. Is this the breaking point or not quite? That, I think, is what people are wondering.
And the good news stateside is we're still at 430. Which is the low end of the range. I believe we're still down on the year as well for 2025. Much more disturbing, I think, is what's happening further out along the curve, 30, say, and beyond America, what's happening in the UK and in France, where the bond market is asking for corrective action in those countries. I don't think we're there yet, stateside, but we're certainly there beyond those levels in France, in the UK and elsewhere.
I just wonder what the response is going to be from policymakers. Maybe it's just not to issue the debt, because ultimately, at what point is it just a dead denomination because there isn't the demand for it at a time where we can't see out 5 years, let alone 30?
Ask the Treasury Secretary the same question when he was sat in the seat on this programme. What's the incentive for anyone right now, the UK, France or otherwise, to issue out along the curve at a point where the investor base is turning around and saying, don't want it anymore? Don't want it.
And what you're going to expect is that they're probably not going to issue as much, and we're already hearing that. So will it become a rare currency or a rare denomination that people will go to even more? I mean,
like
this is
20.
But these are the questions. Then does it offer value if they're going to reduce issuance? Then it actually is it the Matt Hornbach view of the world that you've got to coalesce around?
Bond yields higher around the world so far this morning. With an update on stories worldwide with your Bloomberg Brief, here's Yahara. Hey, Yahara.
Hi, John. We have more details on the Klarna IPO. It is looking to raise as much as $1.27 billion in its highly anticipated debut. The buy now, pay later firm plans to sell 34.3 million shares in the IPO, with the price expected to be between $35 and $37 per share. The Swedish fintech will trade on the New York Stock Exchange under the ticker KLAR. And as you all were just discussing, the yield on 30-year gilts climbed to the highest level since 1998 as an already rough fiscal backdrop adds pressure to the Bank of England ahead of its meeting this month. But it's not just in the UK. 30-year bond yields around the world are rising to fresh multi-decade highs amid concerns over inflation and government financing. And here, the Treasury Department has given a first look at the jobs that will qualify for President Trump's no tax on tips pledge. The 68 jobs mentioned include waiters and bartenders, bellhops, golf caddies, and home electricians, to name a few. Treasury Secretary Scott Bessent described the full list, which has yet to be released, as expansive and fair. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next on the programme, the morning calls as Ferrari shares are higher following a recent upgrade. Plus, Ken Hoexter of Bank of America as shipping companies face fresh headwinds. All of that just around the corner.
I think the administration is going to go to the Supreme Court and get a final determination on whether the tool they use to put these tariffs in place are going to stand or not. If they fall, they've got a lot of other options. They've got many different statutes they could go to. It is not the end of the story by any means. There's a lot of other options out there.
That was Everett Eissenstat, the partner at Squire, Patton, Boggs and former National Economic Council Deputy Director, following the legal pushback going into the weekend on President Trump's tariffs. Now, there's a few people already this morning pointing out that maybe some of this is showing up in the bond market, seeing 30-year bond yields higher, 10-year bond yields higher. Just the idea being that maybe the offset, the revenue raising of this tariff effort, has supported this bond market over the last month.
Henrietta Treyz came on and said that this reduces some to the tune of $2 to $3 trillion revenues to the U.S. Treasury Department if there is this full rollback of IEPA, of the tariffs that have been put under that statute.
The issue for the bond market, though, is that is one small issue in the grand scheme of things. Bond yields are higher stateside. They are much, much higher worldwide. In the UK, in France, in Japan, yields higher across the board. The equity market a whole lot softer on the S&P, the Nasdaq and the Russell, following some massive outperformance on the Russell in the month of August, up 7% this morning, down by more than 1%. The S&P 500 negative by 0.9. That's the price action. Here are the morning calls. First up, Mizuho raising its price target on Alibaba to 159, saying the firm has the best cloud assets in China. Your second call from Deutsche Bank upgrading Ferrari to buy, expecting the supercar maker to unveil ambitious new targets next month. Their stock is up by another 1%. And finally, Barclays raising its price target on Ulta Beauty to 617, citing increased transactions and growth across all categories. Let's turn to the shipping industry, as the end of the de minimis exemption is causing fresh headwinds. Bloomberg's Brendan Murray joins us now for more. Brendan, welcome to the programme, sir. As always, difficult to keep up. Share with us the latest and what's going on this point.
Yeah, exactly. So what we've had is about 2 or 3 dozen mail services from around the world that have suspended the shipment of these smaller parcels to the U.S. because they don't have the sort of back office facility yet hooked up to the U.S. Customs Agency to process these shipments or to pay for them. So the sender is responsible to pay the tariff, and if they don't have the linkages connected between all of these various mail operators, these parcel delivery companies, then all these packages are going to sit around or not get sent at all. So it's gonna create some disruption in this particular part of global trade. These packages that ship a small amount of goods worth not a whole lot of money, but they can add up. There are something like 1.4 billion of them sent into the U.S. every year. That's something like 4 million a day. So it's a huge volume, even if the value of them is small.
Brendan, you track a lot of the volume. Just talk to us about what's happened, not just with the US to China and China to the US, but around the world. One thing that we've noted, and Lisa and I were talking about it earlier, is that tariffs might have gone up and trade between the US and China might have gone down. But global trade between China and the rest of the world seems to keep on increasing. And that trade surplus doesn't seem to be going down at all.
Yeah, exactly. I mean, we've seen it play out in recent weeks, where China and other countries that are hit with U.S. tariffs, they go out on missions to try to establish new trade relationships and build those up if the U.S. relationship is deteriorating. So, look, we've had this huge spectacle in China over the weekend with India, Russia, and Xi Jinping hosting those 3 leaders of the BRICS countries. And this is the fragmentation of the global economy happening before our eyes, and it's yet to be seen whether the U.S. and Donald Trump can use this particular tariff authority that he's launched this latest trade war with. But as these experts say, he's got a lot of tools that will allow him to impose tariffs on U.S. imports. But those tools are slower, and they're less broad. You can't just flick a switch and turn them on and off the way President Trump has done with his reciprocal tariffs. So the bottom line is there's just a lot of uncertainty. There already has been, but this just extends it out until the courts resolve this issue. If you're a small business or a company looking to hire or invest, you're looking at the situation and going, what do I do? Do I wait or do I go now? It's just it's going to extend this period of uncertainty.
I don't think you know what to do. That's for sure. Brendan, appreciate it. Bloomberg's Brendan Murray there out of London. Ken Hoexter, the Bank of America Securities Senior Analyst of Air Freight and Surface Transportation, joins us now for more. Ken, good morning.
Good morning, John.
Let's extend some of that conversation, and thanks for being here. Let's take the de minimis exemption. Can you just walk us through, give us a feel for how much of the overall volume between, say, trade between the US and China that actually accounted for through air freight alone?
Yeah, and happy post-Labor Day. Welcome back to work, everybody. So, it's a great question in terms of, Brendan was mentioning the 1.5 billion packages a year. It's about 4 million a day. So you've got a lot of frequency. UPS and FedEx export combined about 2.8 million packages per day. So they're representing, and that's not all de minimis, but a huge portion of this de minimis movement on a per day. But international is only about 25% of each of UPS and FedEx's revenues, and then the export portion is only 17%. So we're still talking a small portion, as Brendan mentioned, a smaller portion of the number of volumes, or the high volume but low value of the packages moved. But this is meaningful. This is the highest profitable lane, is the U.S.-China lane. So we've already seen those volumes down about 75% year over year once this went into effect in May. The new news here is on Friday, it expanded to the rest of the world. So that's about 24% of de minimis is now encapsulated in this new expanded part.
How enforceable is this?
So it's enforced by the U.S., right? So it's something that our Customs and Border Protection Division is going to be watching. And so now everybody has to comply. The difference of what's going on before is UPS and FedEx already required the information on what's in the package, but now you've got to get who made the packet, who made the goods. And so the difference is the postal operators. He was mentioning 30 different postal service operators suspended because they don't have the technology. Before, you could just check a box that this was a small, low-value package. Now you've got to give so much more information. So that's guarded by the CBP on imports.
No, I was just wondering, if you get on a plane, let's say, and you get $500 worth of goods from some country, how do they come on the plane and get it? I just wonder, is this, I'm just thinking theoretically, stop laughing at me. I mean, how do they enforce this? Does it become difficult given all of the changes in the tariff regimes and some of the legal challenges?
Yeah, what you're carrying on you, that's still not going to change as far as that $800 limit, right?
But this is just looking to clarify for personal reasons.
This is mailing cross-border, right? So this is what's going in packages, what's going on vessels, what's going on different methods of transport, even rail cross-border. So they're managing what packages are going cross-border.
Of the companies that you follow at the moment, who's executing really well? Who have you been impressed by?
Well, I mean, they're executing in terms of FedEx and UPS already move traffic, right, have the skill sets. But this is a question about what's going to happen with the increased rates to those packages. So, for example, Temu and Shein, right? These were low-value shippers that had found a loophole and expanded that loophole. We went from 100 million packages 20 years ago to 1.5 billion, right? And that's already up to 900 million packages at run rate by the time this went into effect in May. So you're seeing this. This is really taking those companies that learned how to take advantage. And what you've seen is Shein's volumes are down 23%. I'm sorry, down 12%, but revenues are up 23% because they've taken rates up to adjust for the tariffs, or they've gone in and as you were mentioning, gone to different countries.
Super smart. Ken, appreciate your time.
Thank you so
Come
much.
back soon. We'll do it again. Ken
All right.
Hoexter there of Bank of America. Are you shipping a parcel sometime soon? On your person?
On my person? Or am I going to pack myself with gold bars from London? Look, I do think that what the point here is, does it kill the fast fashion industry? I mean, just to be serious, aside from the fast fashion of getting on a plane with lots of clothes on.
Would that be a bad thing?
Well, yeah, but you know what I'm saying? That's the issue is that, I don't know that my kids are going to get from Shein in the same kind of way, and maybe that's positive.
The businesses that were viable 6 months ago maybe aren't anymore.
Or they're just going to jack up prices.
Yeah, we've still got to figure it all out.
Yeah,
how do you price this if you're a company at the moment?
This is the reason why I just wonder, do they come back to the office and say, let's invest?
Up next on the programme, the sneaky ball case.
Yeah, exactly.
Is that what that was?
I just wonder. I'm curious.
Erin McLaughlin of the Conference Board joins us in just a moment from New York City. You're watching Bloomberg TV. On many occasions, you wake up in the morning stateside and Asia or Europe's had a bit of a freak out and the American session buys it. Not seeing that so far this morning. We'll see if this sticks, but at the moment, we're negative and getting lower. We're down 1% on the S&P, down by 1.3 on the small caps, and in the bond market, yields taking another leg higher. Up 7 basis points now on 10s, approaching 430, up 6 on 30s, approaching 5% at 498.93.
Yeah, and you just wonder whether this is being led by the United States or whether it's being led by the rest of the world. And that ultimately is the question. You asked, John, whether this is tied to a lack of revenue coming from tariffs, if the IEEPA statute isn't enough to justify this government. But there's a bigger question, and is it a loss of credibility of governments in France and the UK, in addition to what's going on in the US, that's causing this global sell-off?
And arguably, the US is in a more comfortable seat at the moment relative to what's taking place in the UK and France. And you and I were talking about it just briefly. The moves we're seeing outside of America, these moves in the US aren't screaming for corrective action from Washington, D.C. The moves in France and the UK are. And I'd be much more worried if I was sitting down in the United Kingdom, facing down the prospect of putting together a budget in a few months' time, with yields at the highest since the late 1990s and up again this morning, and pushing 5% on 10s and on 30s, pushing 6.
Yeah, with a currency that is rapidly depreciating, with a pound that is losing ground versus the euro and versus the dollar, are they willing to make the hard decisions? And what does that mean for growth in a region that's facing off with a real conundrum?
What are the hard decisions? The hard decisions aren't putting up taxes. The hard decisions are cutting spending. That's the most difficult decision they've got to make at the moment. And you and I went over it briefly. This is not about ability. They have a majority in Parliament. This is about willingness of MPs to follow through. And the market's going to keep demanding it. We talked about this last week. I think it's really, really important. At what point do they believe they need to vote for those kind of spending cuts that the market is asking for? And I think we basically concluded that politicians won't vote for this until the alternative is worse. And the alternative needs to get worse before they vote for it. And we're just not there yet, which means things can get worse in the UK, they can get worse in France, before the corrective action is taken.
This is John Ferro asking for the bond vigilantes to pick up the pace, make things worse so that things can get better.
Not what I want
that's a little bit. I mean, that's kind of the idea. I mean, what is the pressure? It's going to come from the bond market. They're the adults in the room. That's what everyone keeps saying. And the question is how much they have to push back before there is corrective action. And that is ultimately this sort of game of chicken that we keep talking about that isn't quite there yet this morning.
I don't think it's a game the UK wants to play.
Nobody wants to play.
Or France, for that matter. And let's see if there's a central bank willing to step in sometime soon, because right now I don't see signs of that either. That can change, but I don't see signs of that right now. Under 1 hour away from the cash open, let's turn back to the equity side of things. Bit of a downdraft this morning. We're lower by about 1% on the S&P and lower by a whole lot more on the Nasdaq and the Russell. With your morning movers, here's Danny Berger. Hey, Danny.
A really tough start to September, John, so you've got to find some positive stories where you can. Pepsi, by far, is one of the biggest winners today. It's a report from the Wall Street Journal that Elliott Management has taken a $4 billion stake in the company, an activist stake, hoping to turn around PepsiCo, which has been falling and lagging its peers. So those shares up 4 1/3%. But elsewhere, some bad news for the beverage makers. We had earnings from Constellation Brands, the beer maker. Really tough set of results. They see for the full year some of their sales declining between 4 and 2%. They cite the macro environment that not only is consumer demand weaker, but it is just frankly more volatile, and that makes things like judging their inventory increasingly hard. So those shares down 9.2%. Finally, some of the gambling companies, those are also falling on some news. A report from CNBC that you are looking at a new gambling venture opening up with Crypto.com and Underground Sports. So that means just more competition for the existing online gambling companies. So Flutter Entertainment and DraftKings both down by more than 1%, John.
Danny, thank you. Appreciate the update. Danny Berger, Matt Miller taking over things in about 26 minutes time. So look out for open interest at 9 a.m. Eastern time. That's some of the morning movers. Let's turn back to the labour market. Key data coming out through the week, including Friday's highly anticipated payrolls report. With a look ahead, here's Mike McKee. Good morning, Mike.
Good morning, John. Well, let's pick up on what Danny said about trying to find some good news. Are we going to find any in this week's big data releases? August is over. It's the first week of September. And that means the big data numbers for the month get released for the most part this week. And we start today with the ISM manufacturing numbers. Are they going to show any kind of rebound? And what are they going to show us about prices paid? Factory orders, jolts. And the Beige book tomorrow, Beige book will get some interest. Thursday's a big day, not only for the markets, but for Lisa, because ADP comes out. And, you know, it's really weird, Lisa, that everybody in the markets is saying we're suddenly going to pay much more attention to ADP, since we don't necessarily know if we can trust the jobs report. We'll get a lot of attention paid to that. Jobless claims also on Thursday, and then Friday, as you mentioned, the August jobs report right now, 75,000 jobs created, expected, but given the revisions last month, we're going to be looking to see what the ISM, the ADP, the jobless claims tell us that might change minds among those who are prognosticating for Friday. What else to watch? A lot going on. Besides just the data numbers, we've got the Lisa Cook situation. The judge last week gave the plaintiffs, Lisa Cook and her lawyers, till today to file a response to the government's arguments. We don't know what happens then. Does she make a ruling, or does she ask for another hearing? We hope to find out something today. Stephen Myron gets his hearing on Thursday to become a member of the Open Market Committee, a Fed governor, and we're expecting perhaps a vote next week on the Senate floor. Alberto Musalem speaks on Wednesday. I put this on there because he's been one of the more hawkish members. Has he changed his mind? Is he more open to the idea of that September rate cut? And then, of course, we're all waiting for the administration response to that IEEPA ruling, because if the tariffs are on, if the tariffs are off, that's going to make a big difference to what the Fed does. We probably won't have a decision by September meeting, but we'll have something for them to think about, no doubt.
Mike, just before you go, ADP, can you just sit on the ADP report just for a few beats? Can you explain to us the relationship between ADP and payrolls more recently? And has ADP given us actually a decent look at what's happening with the labour market? And have we actually seen those downward revisions on NFP come down towards ADP?
Well, that's a possibility. ADP, of course, tells you you can't use their data to predict what the NFP numbers are going to be. And remember, these are private payrolls. They don't include the government side of the payrolls report from the government. But they have been closer now, given the revisions. And we have some big revisions coming next week to the prior year's NFP numbers. So they might become even closer then. But what is important is that the Fed buys the ADP data on a weekly basis, and they track it. So if the Fed is looking at ADP and the ADP numbers are bad, and last week Chris Waller said they might be, then that's going to really influence the market's thinking about what we might get on Friday.
Mike McKee, thank you, sir. Looking ahead to ADP on Thursday, payrolls on Friday. Stephen Myron coming up too. That's box office later this week. For those of you that follow these things, that really is box office.
Especially given the push to try to get him into the seat before the September 17th meeting at the Federal Reserve. Should be fun. Should be fun to watch. So let's see how quickly they can get this through.
I imagine some senators will be more fired up than others, maybe.
Are you thinking about somebody?
I'm thinking of the senator from Massachusetts.
Yes, say the
perhaps.
Last name rhymes with Barron.
Yes, just about.
Tarn?
Kind of.
Okay.
We can redo that another time. So this is live, by the way. Okay. Let's stick with the upcoming data. Erin McLaughlin, the senior economist of the Conference Board, joins us now for more. Erin, welcome to the programme. Let's talk about your data, the loss of confidence. Are you seeing that more pronounced, or have we seen a bounce back as we come into the post-Labor Day period?
We have not seen a bounce back yet. It is still, after our sort of dip after Liberation Day, it elevated a little bit in May, and it's still very similar, those numbers. Looking at sort of a trend or a possible emerging trend, it looks like younger consumers under 35, are feeling more negative than some older consumers. And we think in part this might be, well, in general, because of cost of living. But one thing that we're also closely looking at is the end of de minimis and the additional cost for fast fashion and other items.
Hold on a second, Erin. Are you saying that because people can't get their Shein packages and that's typically the younger individual, they're feeling worse? Is that what you're sensing?
I am sensing that could be the case, yes. So we've done some analysis. These packages that have come directly from China, other places from around the world that have really boomed the last few years. And in fact, 83% of e-commerce packages come de minimis, and they came in virtually without any tariffs on them because they came direct from China and elsewhere. And we think that the additional tariffs could add up to 0.2 percentage point on inflation over the next year. And, it could be a downer for younger consumers.
Taking a step back, there are two prongs to the consumer confidence side of things. On one hand, there's this question about inflation, which has been a really dominant theme over the past number of years. On the other hand, it's employment, and that's kind of what we're looking for to understand what the breaking point will be. Are they still confident that they will have jobs? Are they still confident enough to keep spending, even if they don't feel very good about it? Because they haven't always done what they've said they've felt when it comes to inflation.
Right. Right now, it seems that consumers still feel that the labor market is fairly healthy, although they're starting to reveal in some of the answering of some of our data that they sense that there's less jobs available out there, which is kind of interesting. So personally, they may feel confident, still continue to spend, but we do think the spending will be on sort of not on discretionary goods is where it will weaken, that non-discretionary goods is where consumers will continue to focus. And that when it comes to big purchases like appliances and automobiles, as tariffs increasingly have an impact on these, we just may see that confidence erode in the future months.
Erin, let's talk about confidence, particularly about the labour market. I think there's a lot of confusion right now about whether the step down in payrolls for growth is leading towards an increase in labour market slack or not. What do the attitudes of consumers towards the labour market sound like now relative to where they were only 6 months ago?
Well, I think consumers recognize that the labor market is loosening, but consumers often act based on their own situation. So if they feel confident in their own situation, they will continue to spend generally. They may be a little bit more wary, but if they see, even though the unemployment rate has remained steady, if they sense that there's less jobs out there, i.e. if they lose their job, it will be harder to get a new one. That will certainly has a potential to impact their confidence.
Erin, appreciate your time. You see that in continuing claims at the moment. Erin McLaughlin there, the conference board. You see it in the conference board data as well. Made a note of this one, Bramo. I'm sure you saw the same thing. The share of consumers that said jobs were hard to get rose for a second month to the highest since 2021.
Yeah, and the ratio between hard to get versus plentiful has been problematic for people looking for some sort of positive sign. At what point does that start to impede confidence enough to create the sort of stagflationary fear that we saw earlier this year? Right now, we're not seeing it. And we've seen that the confidence surveys haven't always tracked what they're doing. And we're seeing the spending, at least in earnings, which is what is giving a lot of people confidence in small caps.
Might be seeing it in this market this morning. A loss of confidence. Equities down by more than 1% now on the S&P 500. That's the equity situation. If you turn to the bond market, 2-year, 10-year and 30-year bond yields higher across the curve, up by 6 basis points on 10s, up by 7 basis points on 30s over in the UK. In the United States, we're seeing a similar move. So it's the UK, it's the US, it's France. This is a global story that keeps building and building. Got glimpses of it over the past year or so, seeing another glimpse, another bout of it so far this morning.
You know, the point that you made, that normally when we see a freak out or a yippiness, it starts in Asia trading where there are fewer traders there that are actually engaging with futures, thinner trading. And then it sort of diminishes as the U.S. session opens. This time it's been the opposite. And what does this mean about sort of doubling down on the themes that we're talking about, or at least the mood of people coming back to work? Maybe it's just a moodiness. They don't want to get off the beach.
That's what you're putting this down to.
I think that people are coming back and they're saying, this is really concerning. Question about tariffs. Maybe just lock in some gains for now.
Extend the long weekend.
I think that's the message.
I'd be very happy to extend the long weekend. Got to cancel the opening bell.
I think that would be great. And then tomorrow it'll open great.
Cancel the opening bell. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahira. Hey, Yahira.
Hi, John. The Trump administration is preparing to take its case to the Supreme Court after an appeals court ruled that the bulk of Trump's global tariffs were illegal. Treasury Secretary Scott Bessent saying the appeal will emphasize the long-standing trade imbalances facing the U.S., as well as the need to curb the flow of fentanyl into the country. Meanwhile, Secretary Bessent also saying over the weekend the Trump administration may declare a national housing emergency this fall. He declined to list any specific actions, but Bessent told the Washington Examiner that housing affordability would be a critical leg of Republicans' 2026 midterm election platform amid tremendous financial disparities in housing. And gold prices climbing to record highs, punching above $3,500 an ounce at one point, as investors add exposure to the precious metal in anticipation of rate cuts from the Fed. Gold has risen more than 30% so far this year, making it one of the best performing major commodities. Traders are looking ahead to Friday's job print for further signs of rate cuts. That's your Bloomberg brief. John?
Yahira, thank you. Thanks for this morning. Up next, we'll set you up for the day ahead. Plus, we'll catch up with Kathy Jones of Charles Schwab.
This last inflation report showed hardly any signs of tariff-driven inflation. It's really hard to look at the inflation that we're getting and cry foul about tariffs. We think it's coming, but we have thought it was coming for several months now, and it hasn't shown up to the extent that we thought it would.
Matt Hornbach of Morgan Stanley looking ahead to inflation data a week away, next week on Thursday, this coming Friday. Payroll's just around the corner. We'll get to the week ahead in just a moment. Want to turn to the price action. Equities, another leg lower. Session lows, down more than 1% on the S&P, down by 1.5 on the Nasdaq and the Russell as well. In the bond market, attention on the long end of the curve. 10s and 30s up by 7 basis points on 10s, up by 6 on 30s, and getting closer and closer to 5% on 30-year bond yields. Pointed out a few times already this morning, it's not just a move in America, it's a move made worldwide. We're seeing it in France and the UK. I think also worth pointing out on a 10-year maturity, yields in America are actually lower on the year by more than 20 basis points. In the UK, they're higher by more than 20 basis points. In France, they're higher by more than 40 basis points. So the move we're seeing elsewhere So far in 25, much more dramatic.
Yeah, decade highs when it comes to European bond yields, although in the United States it's coming with a question mark. Why are yields higher? Is it an inflation story or is it a growth story? And that ultimately will decide whether this is a good thing or whether it's a bad thing for equities and other risk assets.
I mentioned the week ahead. This is how things are shaping up. Later on this morning, first data point of the week, 10 a.m. Eastern Time, ISM Manufacturing at 2 p.m. Look out for an announcement from the President, Donald Trump. On Wednesday, JOLTS data, durable goods, plus the Fed's Beige book. On Thursday, the ADP report, another round of jobless claims, and a Senate hearing on Stephen Miron's Fed nomination. Before we get to Friday, the main event, the big one, the payrolls report just around the corner. And the range, let's just say the range is already pretty wide for Friday. 115 at the high end, 0 at the low end, and the estimates are still coming through.
And how credible will the numbers be after the firing of the Bureau of Labor Statistics chief? And how will the administration message this, given their concern the first time around? We got the last jobs market report and some of the turmoil that ensued subsequently.
Kathy Jones, the chief fixed income strategist at the Charles Schwab Center for Financial Research, writes the following. The bond market is struggling for direction. Yield curve steepening remains the dominant trend. Kathy joins us now for more. Kathy, we're seeing that steepening again this morning in the US, in France, in the UK. Can you pick one dominant driver of things, Kathy? And if so, what is it?
Well, I guess the story is, well, there's two things. There's inflation being stubbornly high, and there's deficit spending that continues to increase with no checks against it. So you have these policies that really are incompatible with lower inflation and with lower yields. And that, I think, is driving the market in the long end, pretty much around the world. And don't really know what's going to change that dynamic unless you get policy changes and or some sort of recession signal that actually pulls long-term yields down.
We had Matt Hornbach on earlier today, and he was saying that this actually is a good opportunity to buy the long end of the yield curve around the world, including the United States, if you are a long-term investor. Do you agree with that?
Well, real yields are high at the long end, so you could make the argument that if you're willing to ride out the volatility, that this is an opportunity. I'm not terribly enthusiastic about that because I think that opportunity will get bigger as we go forward, unless some big change happens. But I would say the bond market is telling you, not just here, but everywhere else, that it's worried about the path that we're on. And I don't see what's going to change that path anytime soon.
So in other words, you think that yields are going to go up even more. What do you think the pain point is that would actually prompt some sort of change on the policy front that would prompt you to see an opportunity?
Wow. I would have thought we'd reached that point already. So it's very difficult to say what the pain point will be. I suppose if we go up very quickly, we hit a liquidity problem, which in the U.S. is probably unlikely, but in other markets it could happen, where we start to see it very difficult to finance operations or to get into the market in an orderly fashion, or a big drop in the dollar. Now, we've seen the dollar come down pretty sharply from its peak, but a bigger drop in the dollar might spur some sort of action from policymakers. But at this stage of the game, they seem willing to kind of ride through this and continue to do what they've been doing for decades, and that is cut taxes and increase spending.
Kathy, I've got to say, the US side of things is actually pretty stable. Some stability in the face of what's happening elsewhere. If you told me at the start of the year that we'd have yields down to 429 after all the policy changes we've seen over the last 6 months or so, I think a lot of people might be surprised from that we were approaching 5% before the start of the year, and now we're down to 430 as the rest of the world is freaking out. The difficulties for me lie elsewhere, in the UK, in France. And Kathy, I wonder if I could sort of frame this question differently, whether you believe the US can remain some kind of bastion of relative stability in the face of what's happening elsewhere.
Well, I think the U.S. still has that advantage, having the world's reserve currency, having the ability or some leeway for the Fed to cut rates. I think that there is some room here, but our call for the year was a steeper yield curve as these policies play out, and I think it's very difficult for the U.S. to see a lot of progress on the downside in long-term yields with everything going on in the rest of the world. So we're going to be a bigger market, very liquid. We certainly have the capacity to handle our debt and deficits.
Yep.
We just don't seem to do it. And I think the market will continue to price in a higher term premium until we get some sort of coherent policy or a signal that the economy is really, really slowing down. And we might get that Friday with the jobs report.
Certainly seen those steeper curves, that's for sure. Kathy, thank you. Kathy Jones there of Charles Schwab, thank you very much. Bramo, let's just finish on that note. The US, in the face of everything at the moment, the US is looking pretty good compared to what's happening in the UK and France.
And you could say it's a bastion of relative stability. You put that well. Key question is going to be the labor market data. If it rolls over, how much do you end up seeing the dollar punished in a material way where you see true weakening, in addition to, yields coming down, but a sense that maybe the United States isn't the haven that it was in terms of growth and momentum?
Getting a shortened week at least, Bramo. Had a long weekend, shorter trading week.
I think
sprinkle of economic data.
There is so much going on this week with Congress coming back, with this question on economic data.
What's your favorite?
Well, payrolls report is going to be really interesting, or maybe ADP report on Thursday. That could be most interesting. But I do think that the economic data is going to take front and center. Real questions, though, on the political side as well.
The fact that ADP has taken on this additional importance is amazing, isn't it?
What's your favorite?
ADP.
Hey, there you go.
Super excited for it. Coming up, Julian Emmanuel of Evercore, Kate McShane of Goldman Sachs, Libby Cantrell of PIMCO, Mark Urbana of Bank of America. They join us tomorrow morning. Looking forward to that. From New York City, this was Bloomberg Surveillance.